Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. The issues mount for Apple. Bloomberg saying China could expand a reported ban on iPhones to state firms and agencies. That mirrors a previous report from the Wall Street Journal. Any such move would be unprecedented for the tech giant in the nation and strikes another blow in the so-called trade war. The trouble that doesn't stop there, though, as Apple is also facing down fresh tech regulations in Europe, being designated a gatekeeper along with rivals including Alphabet and Amazon. The pain for Apple stock being compounded by rising bond yields as investors digest economic data and a Fed that looks set to hold rates at its upcoming meeting. The catalyst for the move in treasuries was an unusually strong ISM services reading, which also set the stage for further strengthening in the dollar. It comes as the Fed's beige book said there were signs wage growth and inflation may soon slow further. And the heat wave striking large swaths of the eastern U.S. looks set to peak with temperatures as high as 100 degrees Fahrenheit in some regions. The extreme conditions causing havoc for the Texas electricity grid, so it's not just the East Coast. The state has declared its first power emergency since a deadly winter storm 2 years ago. Grid operator ERCOT triggering emergency operations on Wednesday evening. It now says normal operations are returning.
Well, shares of Apple are lower this morning on reports that China's iPhone ban is broadening across government firms. Staff at several Chinese agencies say that they were given instructions not to use Apple's iPhones or other foreign devices in the office. First reported by the Wall Street Journal. China is one of the tech giant's biggest markets, accounting for just under 19% of its overall revenue. Beijing has already limited government officials from using iPhones. But this new report would significantly broaden that ban and signal perhaps a sharper crackdown on existing rules. Apple suppliers like Qualcomm and Skyworks are also taking a hit on news. Joining us now with more, we've got Yahoo Finance's own Dan Halley, our tech DH. So Dan, what do we know about this so far?
Yeah, this is something that we've kind of seen expand quickly over the past few days about Chinese officials banning or potentially banning. We don't know anything concrete quite yet. How far this goes, what this exactly means for Apple. It does seem as though it's kind of a not necessarily a tit for tat, right? Because the ban on Huawei, the ban on TikTok, with regards to official uses in the U.S. government, across state governments, some universities have banned the use of TikTok on their networks. So it seems as though it's almost a response to that, but also perhaps for the Chinese government side, a way of keeping themselves insulated from any potential hacking. Now, the thing to remember about Apple is their whole MO outside of selling the iPhone is, and has been for a while now, privacy. And so they've worked with the Chinese government to, their detriment in some instances where they've limited the window that AirDrop is available, something that they don't do in other areas. They've taken down apps at the request of the Chinese government, data that's stored or Chinese user data is stored in China. So it's not something where, there's a general distrust seemingly for Apple. Tim Cook has gone there several times to basically, chat with officials. So it doesn't seem as though Apple has necessarily done anything. This seems to be more of, as I said, almost a delayed tit for tat for what the U.S. has done to the likes of Huawei and is doing to TikTok. So, I think the important thing to point out is this is only officials. It's not the general public, although, obviously, this can rile up some, nationalist fervor. People might go out and decide that they need to buy China-made devices rather than Apple devices, and that occurs every once in a while. But I just want to point out the amount of spending from Chinese consumers relative to Apple's overall revenue. So in 2022, Apple had $394 billion in revenue. Of that, $74.2 billion for the iPhone side came from Greater China. And that's just a number that's been increasing over the years. And so, you can see how much of an impact this would have. It's one of their biggest markets, one of their most important markets, and they frequently reference it as an area where they're getting switchers from Android to iOS, and the fact that they're able to get folks onto the App Store. So, getting them into the ecosystem is all part of the broader plan. So, it's not a message that consumers will be impacted, but there's a good number of government officials. So,
right. Well, and now, according to this latest report, it's perhaps expanded to state-owned enterprises. So if you're talking about a PetroChina, which is a huge company, and the other China state-owned enterprises that have a lot of employees, if they're not allowed to have an iPhone, and it doesn't seem like there's anything in writing, this is not an official position, reportedly, it's sort of a soft position. But what's really remarkable about this that you alluded to is that Apple has had quite a close relationship with the Chinese government, whereas a lot of the anti-China policy coming from the U.S., like Huawei is not sitting down with the Biden administration, for example. So that it feels different than some of the moves that we have seen in the past.
It seems almost strange for it to also come out at this point.
Right ahead of the product announcement from Apple.
Yeah, that seems kind of timed purposefully, considering that next week we're expected to get the new iPhone, the new Apple Watch, and so forth. I think that's something that was purposeful. But yeah, I mean, it just seems to be an odd move for them to target Apple. Maybe it's a message to the U.S. that seems to be part of it, saying, look, we'll go after your biggest companies. And it won't be a problem for us. So that could be it. I also do want to point out, though, as important as China is to Apple's overall revenue, they are increasingly putting more emphasis on India as their
in terms of manufacturing, or also in terms of an end market?
Both. So they're moving there as far as manufacturing. They have for a while, but now as an end market, they repeatedly referenced that. I think in the last earnings call, they specifically pointed to India as a place where they're getting more switchers. So it's an opportunity for them to grow. This is the kind of conversation they were having about China years and years ago. So it's basically, part two of their expansion outside of the U.S. and Europe, going, okay, we exploded in China. We're doing well there. They clearly hope that continues, barring any of this. But India is now kind of their big opportunity to grow, and so it's still dangerous for them to lose obviously anything in China, but it's also they're moving on to India as well.
Well, Apple also facing some hurdles elsewhere in Europe as well. Tell us about the Digital Markets Act. A little bit about this came out yesterday, early in the morning, and what that means for big tech and the future of big tech in the EU particularly. Yeah,
so the Digital Markets Act is basically going to upend Apple's App Store. As well as Google's Play Store. It's basically a means to ensure, at least for those two companies, and obviously we have the other companies here that are going to be listed, they're basically going to be kind of gatekeepers to different parts of businesses. So according to the EU, to ensure the ability for smaller companies to compete, what they're going to be doing is opening up, or force them to open up their app stores, meaning you're not just going to have the standard app store on your iPhone, on your iPad. You're going to have to allow a third-party app store to get in there and ensure that other companies can provide their apps. And so Google does this in a roundabout way with Android. They allow you to sideload, although they put all these scary warnings in the way. And to a degree, it is also dangerous because they're generally not as well vetted as you might see apps on the App Store or in the Google Play Store. But for Apple, it's a bigger deal because more people purchase apps on the App Store. Generally, iPhone owners are more affluent, so they're going to be spending more on, whatever Fortnite bucks or, whatever they're buying in there. And so the idea that they're going to have to open this up means they may end up losing revenue. The biggest share of revenue that they get from the App Store, by the way, is from games. And if they're opening up to other game developers' app stores, those people can then sell Fortnite bucks for less, V-Bucks, whatever they're called. Then that's going to eat into Apple's margins for their services division. So it's going to be a big deal. How they go about zhuzhing this, remains to be seen. But if they do it in the EU, it doesn't necessarily mean they'll do it globally, especially if it means taking a big chunk out of their overall revenue.
Mm-hmm. We'll see. And there's, of course, been some legal wrangling over that here in the U.S. So we'll talk more about that next time we talk about this. Thanks so much, Dan Halley. Good to see you. Well, the tech-heavy Nasdaq is off to a rocky start in September, logging 3 straight days of losses, led by declines in Apple and also Nvidia. The sector, which was buoyed earlier this year by AI hype, is now feeling the pressure from the possibility of higher rates as the U.S. economy sees stronger than expected economic data. Just this morning, we had jobless claims coming in a little bit lower than last week. We talked about Apple feeling extra heat as the company's iPhones are perhaps caught in the crosshairs of U.S.-China trade tensions with that potential ban, a soft ban that we talked about. To talk more about the so-called Magnificent Seven and what comes next, let's bring in Kristen Bitterly, Citi Global Wealth Head of North American Investments. Kristen, good to see you.
Good to see you too.
So you heard us talking about Apple, but we have seen a bigger sort of rollover in just the first couple days of what feels like back to school season, right? In these tech firms. What does that tell you? Is this going to continue? Is there going to be some rocky times for these stocks?
I think it's interesting because what we saw obviously in the first half of the year was that these stocks were really the flight to quality. They're the free cash flow generating ones, the Magnificent Seven, really driving the entire rally that we saw for the first half of this year. August was a very different story, really kind of a tale of 2 different months. And then September, you get into this seasonal effect of it tends to be one of the most volatile months. And October, actually realized volatility in October tends to be even higher than in September. So I think this is the market working through a number of different things. It's the Fed's trajectory from here, some of the catalysts that we have on the horizon, and also just looking at the resiliency of the overall market.
Is that a missed rally then? If anybody's looking at the Magnificent Seven at this point, so many different names that we could kind of prescribe to the seven, but if they were looking at this and trying to evaluate if there's still further upside potential, given all of the tailwinds that many of them were able to ride, whether it be free cash flow or the companies that are sitting on the biggest hoard of cash or able to deploy that into future investments as well, is that a missed rally?
I don't think it's an entirely missed rally because what I was saying earlier just about free cash flow generation and this idea that if we are in an environment where you're going to have higher rates for longer, then obviously you would want companies in your portfolio that have really strong balance sheets. But I also think if you are in the camp where you believe that we could see a soft landing scenario, that then you would anticipate that this rally could broaden out into other parts of the market. So for example, looking at the equal weighted version of the S&P 500 versus the market capitalization weighted, that's a very easy and elegant way to say I'm going to play the broadening out of this rally. Looking at areas like mid cap that are trading still at like a 30% discount to large cap and finding those opportunities where the valuation makes sense, the entry point makes sense, and that you haven't really seen a lot of flows into it year to date.
I do want to ask you one more question about big tech, though, and it has to do with China. We have the Apple situation this morning. We also have a couple of congressmen saying they want to see export sales further restricted and maybe some further curbs put on China's biggest chip maker. Does the market fully appreciate the potential risk, specifically to big tech, from slowing China growth and the tension between the two nations?
Well, I think the interesting part of that is that you have slowing China growth, but there's still a lot of uncertainty as to what the Chinese government is going to do. And so if we look at the local Chinese equity market, off about 20% year to date, off over 50% from all-time highs. And so there is concern there as to, if the Chinese government did change their stance and all of a sudden started to stimulate in a more meaningful way, not a 10 basis point cut in rates, but a more meaningful way, what could that do in terms of the broader economic picture? But I think that's an overarching risk, not just for tech companies, but when we're talking about what are some of the risks on the horizon to this soft landing scenario, you have to factor in Chinese growth, just given the fact that they are the second largest economy in the world.
And so in that second largest economy, we've seen a shift in sentiment around some of the U.S. names, even trying to either put technology on the business to business side or even the business to consumer and the handset or smartphone category, as we were just talking about a moment ago. Is there a waning of sentiment that could further impact U.S. companies who are trying to still make sure that they're engaging with consumers more internationally?
I think, well, the international question is a broader international question. Yeah. China's obviously an important part of that, but the broader international question, I mean, you look at India, for example, that has just overtaken China from a population standpoint. So there is an argument in terms of like valuation and where you're seeing opportunity outside the US and that disconnect. And so it's just not a uniquely China story.
And so if you're looking in the U.S. and saying mid-cap provides some interesting valuations here, when you're looking internationally, what's the analog for that? Is there another area that you think is attractive?
So what I would say is when you compare the U.S. to international equities, the U.S. a lot, as we just discussed with some of these tech stocks, a lot of the good news is priced in. And even if you look at something like our economic surprises index, you have kind of the positive side in U.S. equities, and pretty much a lot of negative news is priced into international equities. You have about, U.S. represents 65% of global market capitalization and only 50% of the earnings. So I think looking broadly in terms of some of the multinational companies in sectors that we really like, so healthcare, investing in longevity is a great example that from a valuation standpoint has not really caught a bid. It is not a uniquely U.S. story. It's one that you can actually invest in internationally, and we think that makes sense, not just for the short term, but for the longer term as well.
All right, stay with us here. We got much more to discuss this morning. Wage growth and inflation may soon slow further. This according to a new report that's out Wednesday from the Federal Reserve. The Fed said in its latest beige book that the economic growth in the U.S. was modest in July and August, and as most districts reported price growth slowing overall. Our next guest says the economy's resilience has shown in consumer data and even earnings results, but is it enough to prompt Fed officials to scale back their estimates for rate cuts in 2024? Well, could we see that? That is the big question. Kristen Bitterly, Citi Global Wealth Head of North American Investments, still here with us. So everyone wants to know, of course, and I especially, those who are trying to wait to see when rates are going to come down so that they can make some of those larger scale purchases, like a home. Is a cut something that we should expect in 2024?
I think we should expect a cut in 2024. You can see what the market is doing right now in terms of pricing out some of the cuts that were very aggressively priced in just a couple of months ago. It's this dynamic between hard landing, soft landing scenario. I think one of the things that the Fed has given us in terms of some of their commentary around this, because if you look at what is their mandate, it's really full employment and price stability. And so if they were able to see inflation come down and still have a relatively positive employment picture, what would be then the impetus for them to cut rates? And I think Chair Powell's comments around this, that we don't need to keep rates higher for longer if we're already getting the results that we need from a price stability standpoint. So I think we could see within the second half of next year some cuts start to happen.
Just to sort of normalize rates or whatever.
To normalize rates, and this idea, and I hate to bring this up because I think this was like the topic in August of the neutral rate and R-star and trying to figure out these rates as to where the economy is neither contracting or expanding. I think that's an interesting element in this dialogue. We don't need to be in a full-blown recession or to really see something break for the Fed to say, you know what, maybe we should pull back on rates a little bit.
Yeah, and so for the Fed to pull back on rates, what would they need to see from your perspective in the data that we aren't seeing yet?
The risk to that, inflation, right? So they need to see inflation come down in a more material way. I think the data that we've actually received over the past couple of days, I was going to say past couple of weeks, but the past couple of days, it's been conflicting, right? You look at the ISM services, and that all of a sudden is telling us that the economy is still hot. You look at the data within the beige book, and all of a sudden it was telling you that the consumer maybe isn't as healthy and is making some of these tougher decisions. And really all of that is just concentrated within travel and leisure. And so I think they need to see a more stable inflation for them to really be convinced that their job is done. We're anticipating that we could see about, inflation come down to 3.5%, maybe 2.5% by next year. So this idea of them sticking to their guns on 2% is going to be an interesting dialogue as well.
It will. I mean, we've already been talking about whether they're going to have to bring that. I mean, we've been talking about it, I feel like all year, whether they're going to have to bring that target down. So let's bring this part then back over to investments. We talked a lot about stocks and where you're seeing opportunity. I want to talk about fixed income too and what's happening with rates, because we've seen them climb to some extent and then sort of level off here. So what do you think is going to happen from a rates perspective, and how do you play that?
So I think for the past couple of months, what have we seen? People just pouring into the front end of the curve. And this idea that you can hang out in 6-month T-bills, you can hang out in money market funds. And I mean, that's an important part of fixed income portfolios, very candidly, because if you're getting high, 5.5% type yields, that is very attractive. Cash is an attractive asset class. But if you are of the belief that we've reached maybe peak rates, or that the Fed is towards the end of their trajectory in terms of hiking, you want to lock in some of these yields that are longer in terms of duration. And so looking out the curve 5, 7, 10 years and being able to lock this in, whether it's within government bonds or high quality investment grade bonds, is something that we think makes sense.
And what about in currency right now? I mean, is there any correlation that people should be kind of comparing at least?
This is very interesting because when we look at how strong the dollar is, it is something that, last year it was the second highest level in history. You've seen a lot of dollar strength in terms of flight to quality. We don't think that's sustainable long term, which is some of our diversification into international equities. But you can see with some of these choppy markets that we were talking about earlier and volatility that could be on the horizon till the end of this year, that you could see flight to quality and more inflows and more demand for dollar.
60-40, does it make sense in this environment?
I think so. I think 60-40, look, coming off the back of one of the worst years in history, and really one of the only data points that we have where both equities and bonds were off by more than 10% in the same calendar year. I think when you look at the 60-40 portfolio, and this is a conversation we've been having with a lot of our investors, for those who have been hiding out in T-bills, sitting on the sidelines, we did, kind of the first half of the year do a checkup. If you were hiding out in T-bills, your return was around 2.2%. The 60-40 portfolio has returned around 10%, slightly north of that. And so having that diversification, especially when you're going in between these scenarios of hard landing, soft landing, and that narrative has changed so quickly as we've seen throughout the course of this year. So I think having balance, having diversification, taking advantage of some of these yields is very sensible, but not abandoning equities entirely. There's opportunities there as well.
So you mentioned that you're getting a lot of questions on this point. And so that leads me to what else you're hearing from clients right now. Obviously, you talk to a lot of clients. It feels overall, the investors we've been talking to, that sentiment has broadly improved quite a lot this year compared with the beginning of the year. But are clients feeling that way? Or if they're worried, what are they most worried about? What can you tell us?
I would say there's two topics that come up very frequently. So one, the concept of, are we going to have a recession, and what does that look like? So something that's resonated with us in terms of explaining this is really looking at the idea of a profits recession and a rolling recession. And so a lot of the pullback that investors were anticipating was something that we saw in Q4 of last year. You had 6 out of 11 sectors already in profits recessions. You had 7 out of 11 to start this year. So the recession that everyone's anticipating, we may have done a lot of the damage last year from a price action standpoint, and then you're just seeing this impact, whether it's services or manufacturing or technology or different sectors within the equity market at different times. And so getting away from the idea that it would be a typical recession where everything is then falling at once is a very, very common topic with our investors.
Interesting.
Kristen, thanks so much for taking the time this morning.
Thank you.
Absolutely. Great to see you. Kristen Bitterly, Citi Global Wealth Head of North American Investments, joining us here in studio.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. The debate over student loans comes to a head as federal payments are set to resume October 1st. Many of Americans, millions in fact, are about to possibly have their finances turned upside down. So, where do we go from here? Yahoo Finance is here to address some key questions surrounding the student loan crisis, like what loans qualify for forgiveness or even cancellation? What tools does the Biden administration have in its back pocket to address student loans? How will payments impact the economy? And how should you be rebalancing your budget for this new expense? And finally, are student loans worth it? Join us for our special Student Loans, Crisis or Crucial? Right here, starting Monday, September 11th on Yahoo Finance.
Let's take a look at some movers before the bell right now. Shares of C3 AI sinking today after the company posted a deeper full-year loss than expected and pulled back from its original forecast to reach non-GAAP profitability by the end of fiscal 2024. The shares are down by 13%. Tom Siebel's company, which the ticker is literally AI, and it has benefited a lot from AI enthusiasm this year. But now it seems like investor sentiment is shifting to some extent. I mean, this has been a volatile stock this year, to be sure, as it's kind of AI, yay, and then, but what does that really mean is kind of what's happening here. This is a business-facing AI company, and the company still says it's going to be cash flow positive. It's just not going to meet that net income target on the timeline it expected.
Yeah, I mean, they outright acknowledge the fact that they've been a beneficiary of, the conversation, the chatter around everything AI. They said very early in the call, in addendum to the fact that this is their 11th consecutive quarter where they have met or exceeded revenue guidance. They said that following the release of ChatGPT in November 2022, seeing a dramatic increase in demand for enterprise AI adoption. Now, what does that mean for C3 AI, and are they capturing all of that enterprise adoption? That is, I think, the larger question that is really going to define some of the movers and makers of margins at the end of the day. And so even though shares may have moved on a lot of the conversation and the chatter, it's a larger question of, will C3 AI actually be the recipient of many of those outstanding performance obligations or contracts? And as of right now, for so much of the investment focus and where the demand has shifted, it's been on making sure that the chips are getting, the chips are right. But now, once you get into some of the either cybersecurity elements of it, or the language learning models, or even the applications later on, that's where it's a bigger, I think, determinant of where a company has staying power within the broader generative AI wave that we've been tracking.
Yeah, the company did give some metrics around how many customers. It says it closed 32 customer agreements in the quarter and had 70 active pilots, which are paid tests of its products. So it is seeing some growth, but it's hard to sort of compare that, I guess, on a relative basis here. So we'll keep tracking them to see how they do. In the meantime, we are heading towards the opening bell on this Thursday morning on this holiday shortened week. As I mentioned, we did get initial jobless claims coming in at 216,000, which is a drop week over week, and it's also a little bit lower than estimated as we continue to get sort of conflicting signals on the economy. But broadly speaking, very broadly speaking, they have been better than estimated. So this is yet another data point, better than estimated. The move up that we've been seeing in bond yields has been a bit of an obstacle to big cap tech after investors kind of had been shrugging it off, and then they seem to have started paying attention to it again. So we've got futures that have been indicating a lower open. So we just got the opening bell on Wall Street, and let's do a quick check on the market, sponsored by Tasty Trade. All three major averages are trading lower here this morning. The S&P off by 0.75%, and the Nasdaq once again is the leader to the downside, off by about 1.4% this morning. Obviously, we talked about Apple as playing a role in that on concerns over a drop in usage in China, reports of a sort of a soft ban by government workers for government workers for using iPhones. So Brad, you're over at the Interactive. Talk to us about what's going on over there.
Yeah, as of right now, we're taking a look at the Dow Jones Industrial Average, and as of right now this morning, you're seeing that flat just barely to the downside out the gate here. I'm just going to retoggle our screen so that we can get that view calibrated for our viewers there, and then I'm quickly going to touch on the Nasdaq Composite here so we can take a look at how that's been doing, not just over the course of intraday, where we see ourselves opening to the downside by about 1.5%, but over the course of the week. Of course, holiday abbreviated trading week, but over the course of the past 4 days at least, you're seeing that move to the downside by about 2.7% here today, 1.6% to the downside. S&P 500, we've got that moving lower by about 0.75% here on the morning. Since we mentioned the S&P 500, you know what we've got. We've got to look at the 11 sectors in the S&P 500 there, and we've got them pulled up here for you on our screen. Technology, no surprise there, as you're seeing that taking a leg lower. It's down by about 2%, the biggest laggard on the day. However, utilities, that is finding some some fandom out there. Anyway, utilities, that's up by about 0.7%. So we are mixed right now. Looks like we have about 4 sectors in positive territory, and so that means the rest of them are in negative territory. Ultimately, taking a look at the Nasdaq 100 out of the gate here this morning, yeah, that move lower, especially given what we were discussing at the top of the show with Apple being reflected in share price action this morning. That's down by about 5%. Nvidia, you're seeing that lower by about 3.5%. And then just kind of looking at this on a broad heat map as of right now, this is, I believe, the second straight day that we've seen Pinduoduo pulling up the caboose here for the Nasdaq 100. That's down by about 5%. And actually, as things recalibrate here, Apple said, hold my beer. Also taking a look at the Dow Jones Industrial Average, 30 components there. Yeah, no surprise, Apple there. But also taking a look at just a broader heat map here, you've got leaders in J&J and Amgen. J&J, that's up by about 1.6% as of right now. We'll give you a year-to-date view of Amgen, let you know what they're doing, and ultimately still down over the year. Slower by about 4% right now here.
All right. Well, interesting here that we're seeing this real Apple effect in particular. And I just saw a headline that it's the biggest 2-day decline for Apple going back to May of 2022. Let's talk about another mover that we're watching, GameStop. Those shares are on the move downward of 4% after reported stronger second quarter earnings than expected, but still failed to post a profitable quarter, a feat it has only accomplished twice in the past 3 years. This one-time meme darling, I don't know if it falls into that category anymore or not. I guess it probably does, but once again, for the second straight quarter, did not hold a conference call. The shares had been rising after the report and now are falling here this morning. But, you know, for something that is supposed to be like sort of a darling of the people, if you will, to not actually speak to the people or the investment community in this call, you know, maybe that's a little bit at odds with the image it's trying to portray.
Yeah, perhaps it would have helped to have a conference call. But as of right now, for what we heard through the grapevine, of course, Grapevine, Texas, where this company is based out of. I tried. We're all music fans out here. Why not? You know, taking a look at a few items here within this particular release. Number one, net sales for the period, they were higher year over year, but still not, you know, astounding. But I think one thing that investors might be focusing in on, or might have been focusing in on for a little bit, was in the financials, you saw kind of a shrinking of some of the operating costs that they had as well. And so in that moving lower year over year, perhaps that was giving a little bit of positive energy to the stock, at least pre-market. But as of right now, I think investors still just looking for answers. And in that call is where you would have gotten more of those details about how the company is continuing to move forward in its own strategy, where they continue to expect shrinking some of the costs, where they might expect to return to a profit, if anywhere. Right. But ultimately, for GameStop shares right now, over the past 52 weeks, still down 25%.
Yeah, I mean, basically the backdrop here is that there's more subscriptions going on in terms of gaming. And so in that environment, how does GameStop play? It was helped by the release of a new Zelda, I believe, during the quarter. And so that was something that boosted software sales in particular, which were up by 25%. But, you know, how sustainable and repeatable is that kind of thing? They obviously rely on more releases. Yeah.
Last time I purchased a game from GameStop, I know I'm not the prime audience, but Tiger Woods PGA Tour, way back when.
When was that?
It had to be 2005.
Wow.
Yeah. All right. Well, shares of WestRock, yes, they are jumping today after the company said it's in talks with Smurfit Kappa Group to merge in a deal worth about $20 billion. The combination would result in a packaging giant called Smurfit WestRock. When you put this in our group Slack this morning, I had to look up Smurfit. I didn't know if you were just like serving up a Merriam-Webster's word to us that I did not know. This is indeed a deal that looks like it may go through here. Yeah,
the companies themselves have, after some initial reporting, the companies themselves acknowledged that they were in talks here. So we're talking about packaging, basically, for all kinds of stuff, all different kinds of packaging. The issue is, in this environment, we've seen a drop in demand for packaging because we've seen somewhat of a drop in demand for goods. So that's why potentially you would have some benefit to teaming up. Although Jeffries this morning out with a note and saying, there are maybe some limited synergies and advantages from this kind of a deal. Jeffrey's saying rival international paper has shown maybe there aren't that as many synergies as you would anticipate. So WestRock shares are trading higher. I believe Smurfit Kappa shares had been taking a hit. It is a UK-based company, so the shares have been falling in European trading. But, obviously a $20 billion deal, if it goes through, would be a big one. So we'll have to keep an eye and see if it gets done.
Well, especially at a time where many people who are tracking their packages one way or another, or for the broader push towards more sustainable packaging, if combining these two entities would make it so that we did have more of those targets actually being hit, and perhaps there is some kind of consolidated effort that they can earmark or put towards that. That is perhaps where we would see this packaging giant make sense for just streamlining a lot of those operations as well.
Yeah, maybe so.
Maybe. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Coming up, Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's Next.
Yahoo Finance is still stationed at the Goldman Sachs Tech and Media Conference in San Francisco. Lots to talk about AI and how it will impact many businesses across many different industries. Let's talk about the business of news and how AI may impact that field, which is my field of choice. News Corp CEO Robert Thompson, thanks for joining us. I know you don't do a lot of these, and longtime follower of your career. Thank you for doing this.
Pleasure, Brian.
Talk to us. I think you had some really amazing comments on your last earnings call. You said this, quote, "It's an important moment in the history of news and knowledge." Take us through how AI will impact a business like the news industry.
It's fundamental. It's for editorial, it's epochal. And that's an overused word, but it's absolutely relevant now. And you can ask, well, what is AI? Is AI articulate insight? Is AI amusing incoherence? Is it abject ignorance? Is AI initiating an affidavit initiated? All of those things are in play at the moment. What will AI become? What will the impact on use be? And therefore, what will the impact on society be? And that's why there needs to be much more debate about the role of AI in companies, but there certainly needs to be a lot of debate about AI in journalism. Because if you look at the impact of what is loosely called big digital over the last decade and a half, from 2008 to 2020, 57% of newsroom jobs in the United States have been lost. That's from 71,000 to 31,000. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. And so it's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
I want to get to the big AI players in a second, but what is the impact you mentioned to society? Theoretically, because of AI, we could see an impact in fake news stories. I look at it from the business world. Maybe we're seeing machines write earnings stories. The numbers go out there and they're wrong, and the stock price goes up or down. I mean, what's the long-term ramifications of this?
People have to understand that AI is essentially retrospective. It's about permutations of pre-existing content. And the danger is it's rubbish in, rubbish out, and in this case, rubbish all about, because it's distributing exponentially potentially damaging content. And so instead of elevating and enhancing, what you might find is that you have this ever-shrinking cycle of sanity surrounded by a reservoir of rubbish, that instead of the insight that AI can potentially bring, what it will evolve into essentially maggot-ridden mind mold.
Does AI, and will it play a role in your various publications like the Wall Street Journal and MarketWatch? Do you talk to your tech teams and say, hey, we need to develop this to move even faster to feed these tech beasts?
Well, it'll have an impact in most departments in most companies. And so certainly in editorial, it's not going to replace great writing. And I think there's some misunderstandings.
Okay, I feel safe. Thank you.
It's not going to replace great business journalists. You're definitely safe, Brian. But it will replace certain simple functions in back office and code writing, and it's clearly going to have a profound impact. Anything that is replicative and iterative, it will have an impact. But in newsrooms per se, understanding how can you use it as a tool is important. But it's also having enough understanding of just the essence of it. And essentially it's what you might call a tech triptych in the way that content will be used. The big AI engines are going to scrape content to feed and update the engine. They're going to surface individual stories, and they're going to extract the editorial essence. And in each of those three areas, it's incumbent on the big players to reward those who created that content, or else they're actually undermining the act of creation.
You have some of the most influential publications in the world: the Wall Street Journal, Barron's, MarketWatch, New York Post. I'm sure I'm leaving out a couple right now. I promise you, I read the 10K. I promise you. Yeah. But you take that IP and that content that you create, and then you go and talk to some of these big cap tech companies. You have to be coming from a position of power, no? And how do they push back on what you're asking for?
Well, don't forget, you go back to the original digital debate. It was, hey guys and gals, you should be grateful that we're using your headlines or distributing your content. But there was a massive shift in power from creators to distributors. And there's a danger that shift that has already taken place will be amplified many times over in the era of AI. Clearly, advertising revenue has shifted from the creator to the distributor. And so, again, it really is incumbent on these companies to recognize that responsibility in the end to their own products and certainly to society.
We're about to enter election season. It's going to be a pretty busy 12 months for all of us in this industry. How do you go upon covering it through your various publications?
Well, the objective of our reporters has to be the objective of being objective. And that's what we'll be encouraging, because we live in a world where there's a surplus of subjectivity. And the problem with AI is it can recycle subjectivity and pretend that it's objectivity. And we already see that in some of the AI snippets that we're tracking. And I think that's also incumbent on other news organizations to put some resource into tracking and to understanding, to divining digitally what's evolving, both for the sake of the value of their content, but also to see how their content may be misused or abused.
Within the context of election season, does the ad side of your business begin to pick up in anticipation of this? Or do advertisers say, hey, the last election was pretty contentious, to say the very least. We're going to pull back a little bit on ads. We don't want our name associated with some of the stuff on the internet.
Well, I think generally people will focus their advertising on certain states, because in the US, unfortunately, certain states are kind of gimmies and certain states are swing states. There'll be a lot of money going into those. So we're lucky that we have national digital footprints and influential ones. So I no doubt there'll be some benefit for us. But you would hope, more importantly, that the advertisers also will hold the digital platforms to account, in the sense that they shouldn't be associated, and they have to be discerning about which content which content company they're keeping.
We're asking a lot of the leaders that we talked to here at the Goldman Conference, what's on tap for 2024? What are some of your big bets that investors should be on the lookout for?
Well, for us, keep an eye on Dow Jones. The B2B business there has grown significantly. The margin at Dow Jones in Q4 a year ago was 18.8%. In the most recent quarter was 24.4%. So the Dow Jones is not just the Wall Street Journal, it's also a high margin B2B business. We bought a couple of companies there, one called Opus, another one CMA, which focus on chemicals and energy and renewables. Understanding the power of Dow Jones and also its role in the broader news core, that's going to be our big push for the next 12 months.
Tremendous affirmation for the work you've done and respect for the work all of your teams put forward at News Corp. News Corp CEO Robert Thompson, thank you for joining us. We appreciate it.
Thank you, Brian.
All right, much more coverage ahead from the Goldman Sachs Tech and Media Conference in San Francisco on Yahoo Finance. Do tune in.
Coming up, there's Yahoo Finance's tech editor, slack-jawed and spinning like a pinwheel. Does Dan Halley make it home, though? That's the big question. And does he even make it out of the town square? Find out. Yahoo Finance is next. China's trade slump is showing signs of easing after declines in August came in better than originally anticipated. But the country's weaker economic backdrop is sending the onshore yuan to a 16-year low against the dollar. For more on what this all means, we've got Yahoo Finance's Jared Blickery joining us from the floor of the New York Stock Exchange. Hey, Jared.
Hey there, Brad. What better place to talk about the Chinese market than the floor of the New York Stock Exchange? And I say that a little bit tongue-in-cheek, but these are some of the biggest stocks in the world that are affected, including Apple. So you mentioned those new import-export numbers that came out overnight. Better than feared, yes, but looking at, 8.8% drop in exports versus a year ago, 7.3% drop in imports. And then you take a look at what's happening with respect to the trade figures between China and Europe. Those are down double digits. That is still huge. That is a big hole to climb out of. And so far, as we've been reporting, the Chinese authorities have failed so far to really secure their markets, to stabilize their markets. Used to be 10 years ago, the Chinese investors, they would try to save in stocks. Chinese government put an end to that, got them to save in property values and in real estate. That has fallen apart. And so Chinese authorities are a little bit desperate. Let's go to the Wi-Fi Interactive. I just want to plot the Chinese currency. This is the US dollar versus the Chinese yuan over 3 months. And the US dollar has surged. You can see that uptick, that latest uptick there, to the highest levels since 2007. This is a MAX chart that goes back over 20 years. And just to show you what's happened over the last 5 days, in the US dollar versus all these other currencies, really interesting to see the Mexican peso. The US dollar has gained the most versus the Mexican peso out of all of these currencies. Why is that important? Well, foreign currency traders in Asia, when they wake up in the morning, they look at the cross between the US dollar and the Mexican peso because that would be Mexico being the biggest country that is next to the dollar reserve currency of the world. That is, of course, the US. So we're looking at a year-to-date chart of the US dollar versus Mexican peso. You can see the US dollar weakening, but now it has broken out. Is there something there? Mexico has rates way above ours in the 11% range, and there's also the Bank of Japan. You put all these things together, it looks like there's some trouble potentially brewing in foreign currency markets. Both the Bank of Japan and the People's Bank of China have their work cut out for them. They need to rein in their currency devaluations, and they're kind of grasping at straws right now.
Yeah, well, we'll see if anything changes on that front. There's been a lot of predictions that they might. Thanks so much, Jared. Appreciate it. AI has been really the key word and phrase in 2023 as companies spanning from big tech to cybersecurity doubled down on development. Today, Time is releasing a comprehensive list of the most influential names in this space, from Elon Musk to OpenAI Sam Altman. Jessica Sibley is here, Time Chief Executive Officer, to talk us through this list. It's a pretty incredible list because you do have names like Elon Musk on there that people have heard of, a lot of big names, and you have a lot of names that aren't household names, but maybe they will be, given the way that AI is going. Talk us through how you put the list together.
That's exactly right. We are so excited at Time to launch our inaugural Time 100 AI list. We have been extensively focused on this topic at Time. From the launch of ChatGPT to the Time 100 most influential companies, where we got unprecedented access to Sam Altman and his team at OpenAI. So today on Time.com, you can look at the list. We are identifying and recognizing the most incredible individuals that are driving the conversation and shaping the future of artificial intelligence. The list is extensive, as you said, in terms of identifying those that are icons. So you mentioned Elon Musk and Sam Altman, and we've got Reid Hoffman and Eric Schmidt, and those household names in AI that we've been talking about. We also have so many individuals that are activists, that are entrepreneurs, that are technologists, that are policymakers, and leading a lot of other conversations around AI.
And so even as we think about some of those figures who are leading the conversation around AI, for a lot of the viewers here, they focus on the public markets. They focus on some of the names that are driving this, like an Alex Karp at Palantir who made the list,
yes,
like a Jensen Huang who made the list as well. So take us into how, even of the figures that they have not heard of, who they should be keeping their radar on.
Right. So for this list, we really looked at 4 different categories. The first will be most familiar to your audience, which are really those that are driving the conversation around leadership. So they're the founders, the funders, the financiers, the C-level executives that in many cases are at startups that are now having billion-dollar valuations. The second are the thinkers, those that are focused on leveraging the technology around AI to solve the global societal challenges, whether that's in healthcare, whether that's in cancer, and even climate. We're also focused on the shapers, those that are in research, in academia, political scientists that are trying to understand ethics and equity around AI. And then finally, the innovators. How do you tie regulation? How do you tie policy making to make sure that there isn't misuse in AI? So those are the four categories.
One of the things that struck me about the list was actually how diverse it was, which is kind of surprising, I think. I think people still think of tech as not necessarily very diverse. And it's also interesting given the discussion around potential bias in AI. Does this sort of make you hopeful that is such a diverse group of individuals who is working on this?
Yes, we're really proud of the diversity and the globality around this list, as well as the age span. So this list, 50% are people of color, 40% are women and non-binary, and we have ages ranging from 18 to 76. So 18-year-old activist who's focused on ethics, who is running on-court justice and just met with the Biden administration. And then we have Jeffrey Hinton, 76, who left Google to focus on some of the dangers. But we're really excited about the diversity. McKinsey just came out with a report in July that said that jobs will be replaced more so by women than men as it relates to AI. So we're really excited to launch Women in AI in a platform that will continue throughout the year to focus and recognize on who these women are and how we can change that going forward.
Yeah, as Julie was bringing up ethics, one of the people that is on this list, Margaret Mitchell of Hugging Face, the chief AI ethics scientist. We actually had Hugging Face's co-founder, CEO, Clem, on just a few weeks back after their most recent raise. When you hear from some of these founders right now, what are they telling you about where they would like to see the industry continue to move at this point?
There's promise and there's perils. And so the focus is on driving innovation, driving efficiency, driving productivity, but using AI responsibly. I think another example, in addition to what Margaret Mitchell is doing, is Audrey Tang in Taiwan. She's bringing everyday citizens into the conversation around AI. So this doesn't have to just be a conversation about driving wealth and driving company value. This has to be a conversation about how this technology and how the leaders in the space that Time has identified are going to make the world a safer, better place, and that we could leverage AI to solve, again, some of the biggest challenges.
You've been a journalism executive for your whole career for a long time, and you've seen different waves of different technologies and different trends. How does this one compare to the other ones that you've seen in your career?
We always feel that this is the biggest change ever. This one probably is. I have to quote Sam Altman, we can't predict the future, we just don't know. We are going to cover this at Time extensively. We're going to look at companies, we're going to look at individuals. We're covering this around the world. We've gone to India looking at startups and how AI is able to bring people out of poverty and give them use to technology, especially through voice and translation. We've gone to the UAE where they're leading in, especially with the Minister of Artificial Intelligence, who's also on our list. So for us as journalists, for us at Time, we're going to focus on this and continue the conversations around AI.
We got to go, but from what you've discussed with some of the representatives, even in Congress, who've made this list, does it sound like this is something that we should expect to come up in the 2024 election season, AI as a theme?
We do. We did a really big piece in Time that caused the Biden administration to actually get together and create an AI plan.
All right, interesting. We'll look to see what more we hear from that plan and from Time Inc. as well. Jessica Sibley was the Time Chief Executive Officer. Thanks so much for joining us.
Thank you so much for having me.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. You'll find out when Yahoo Finance is next.
Welcome back. Just after 10 a.m. in New York City, this is Yahoo Finance Live. I'm Julie Hyman alongside Brad Smith, and we are about 36 minutes, let's call it, into the trading day. Let's take a look at how stocks are moving. It's yet another day of declines, in particular for the Nasdaq, as elevated yields are weighing on the tech trade. The catalyst for the move in treasuries, an unusually strong ISM services reading Wednesday, followed by the jobless claims number, which also came in better than estimated this morning. We've got, once again, a disconnect between the Dow, which isn't doing so bad, and the Nasdaq, which is underperforming.
We're also watching shares of ChargePoint. They are underperforming for sure after a disappointing second quarter earnings report. The company reporting a deepening loss to address significant supply chain, according to CEO Pasquale Romano. The company's revenue was a bright spot, though. That was up 39% from the year prior. It's been a rough year so far for ChargePoint. The stock down more than 20%.
We are also watching shares of Dutch Bros, the stock sinking about 4.5% after the drive-through coffee chain proposed an underwritten public offering of $300 million in shares. Dutch Bros saying they're going to use a significant portion to pay down debt.
And Hilton will install up to 20,000 Tesla universal wall connectors at 2,000 of its hotels. It says that the move will create the largest overnight electric vehicle charging network in the hospitality industry. Beginning in early 2024, at least 6 chargers will be installed at each of the selected hotels. The company says searches at Hilton.com show travelers increasingly looking for EV chargers when they travel. Well, tonight, regular season football kicks off as the Kansas City Chiefs face the Detroit Lions to begin the NFL season. With 272 total games spanning over 18 weeks, fans have plenty of action ahead and countless opportunities to bet on the outcome. FanDuel Sportsbook lets football fans place bets and peruse the odds on each matchup in the season. This season, FanDuel's launching FanDuel Explore, simplifying some of that betting experience for fans of all experience levels. FanDuel's Chief Commercial Officer, Mike Raffensperger, joins us now to discuss more on what to expect this season. Mike, great to speak with you here to kick off the NFL season here. Where does this season kind of stack up against years past when you think of the growth that FanDuel is expecting and the amount of wagers that are placed?
This will be the biggest NFL season for sports betting operators around the United States, bar none. We have the advantage of still being a pretty nascent industry. I mean, literally 5 years ago, the industry didn't exist in America, certainly not in an online fashion. You pretty much had to travel to the desert if you wanted to place a sports book legally. Now you can do it in 19 states on your phone across the country, and many others in retail establishments. So this will be meaningfully larger. There'll be a number of states. This will be their first NFL kickoff they've actually had a chance to place. So places like Maryland and Ohio, this will be the first week 1 that they've ever been able to place a sports book. Kentucky will be launching later in September on the 28th. And so we are very excited at FanDuel. This is kind of Christmas, New Year's, 4th of July, all wrapped into one. There really is no week in the entire calendar year in terms of getting new customer trial onto a sportsbook. There's nothing quite like NFL kickoff, so we're pretty excited.
Talk to us about that new customer acquisition as well. Where and how have the companies, especially for FanDuel, how has the industry continued to go about that, knowing that there was a lot of kind of costs that were upfront, but now there are more partnerships that have really emerged and made that possible to embrace a new fan? Yeah,
I mean, look, to break it down, it's much like any direct-to-consumer business, out there. We have a certain CAC, the cost of consumer acquisition that we look at, and then a lifetime value of those customers, and that changes depending on the geography. It changes depending on the kind of bets that they place, who they are, and it's a system that we manage over time. I'd say that is industry-wide, particularly at FanDuel, which we're quite proud of in terms of being the market leaders in the space, has continually gotten more and more efficient over time. One of the more interesting changes that I think many of your viewers will probably notice, this season, more and more of our NFL advertising is going into national ad spots. So a few years ago, we just weren't legal in enough states that it made sense to advertise nationally. So you bought in a local Philadelphia DMA, or you bought the New York DMA. Now you're in enough quantum of the country that the media math is just such that it makes more sense to buy nationally when you're in that larger percentage of the country. And so the overwhelming majority of our NFL buy is in national advertising. I believe the same will be the case for DraftKings. We're really the two large national players. Mm-hmm. And so it's just gotten more efficient over time. I think we feel confident about what we're doing. We've got some really fun partnerships, including one with Sunday Ticket, which for the first time will be available to users on a streaming platform with Google's YouTube and YouTube TV. And so we're really proud of that partnership. We're the only sports book where you can get materially preferred access, $100 off Sunday Ticket if you bet with FanDuel. And so, again, we're excited about the season.
And Mike, when we think about and overlay the kind of betting industry or the amount of wagers that are expected for FanDuel even over the course of this season, and overlay that with the state of the consumer right now, where historically has betting kind of continued to either weather or outlast previous recessions, a recession that we've been talking about for the better portion of a year, and consumers have been just kind of sitting, waiting, seeing exactly what that would mean for their own kind of household expenditures?
Yeah, I think in my parlance, the recession has been betting on the come for a while now. So yeah, I take your drift. Look, we've looked at this pretty extensively. Obviously, in America, we haven't gone through a recession in the time online, wagering has been legal. But if you look at other markets around the globe, fairly consistently, a couple trends emerge. Within sports betting, it does better than average in terms of industry weathering discretionary consumer spending. That wallet stays stickier. And to be a bit colloquial about it, generally people see sports betting as a hobby, and hobbies have more resilience in recessionary environments, and so tends to do rather well. More traditional gaming, so think online casino like blackjack, slots, etc. Those tend to be a little worse than average, and so they're not necessarily a hobby. It's more a form of entertainment, and so that does tend to go along with other sort of discretionary dollars. And so I will certainly not be the person to predict the next 12 months on the macro climate, but generally speaking, I think our business should be doing relatively well. And we have the added benefit if we're just growing, even in a recessionary environment, adding new states, even in more mature states like in New Jersey, you're still not really at maturity in terms of penetration of the market. It's only been legal for 5 years. And so we do have the good fortune of being a young business. We're experiencing meaningful double-digit growth rates year on year in all markets. And when a new state comes online, it's just a virgin market. That's a quite large influx of new customers. And so I think we're well suited and kind of well situated, I guess I should say, to weather recession.
Mike, we got to go. But if you were a betting man, the player to win the Super Bowl, or excuse me, the team to win the Super Bowl, or the player to win MVP this year?
I am a betting man, but I tend to buy the wisdom of the crowd. So I'll give you the insight in the sports book. So these are the most bets, that have been placed. The Eagles are favorites to win the Super Bowl. They came so close last year. They're about 14% of all the bets on our sports book are for the Eagles to win. And, coincidentally, Jalen Hurts, people are really believing in him to win the MVP. And so he's probably that player that is, I think he's got about 21% of bets to be the MVP for the year. So there's the city of brotherly love, Philadelphia. People are feeling it. So that's where I think I put the money.
And sisterly affection. Don't forget that. City of brotherly love, sisterly affection. We love to hear some of those picks that the FanDuel bettors, the wagers, are making as of right now. Mike Raffensperger, FanDuel Chief Commercial Officer, joining us here to kick off the NFL season. Thanks so much, Mike. We appreciate it.
Thanks for having me.
Absolutely.
Streaming giants are also betting big on sports. Google entering the field this season with NFL Sunday Ticket on YouTube TV. The service allows fans from across the U.S. to access all out-of-market games. With more, we're joined by Yahoo Finance's Josh Schaefer and Ali Canal to talk us through what the streamers are looking for. So, Ali, I'll start with you. Always this is obviously very lucrative, and these are hotly contested contracts. What do we need to know?
Well, I think we're seeing this transition to streaming even with the home opener tonight, right? I mean, it's technically considered a Sunday night football game on the schedule since it is the season opener, and that is going to be aired on NBC, but also simultaneously on Peacock. And we're seeing more and more that it's not just these simulcasts, but also more streamers that will be airing these games exclusively. Later in the season, we'll have exclusive streaming games on Peacock, ESPN Plus, and Amazon. This has been a big push from NFL Commissioner Roger Goodell. He's been very focused on making sure that the reach of the NFL can get to as many people as possible. So while the NFL has been very focused on eyeballs, these streaming giants really want to increase engagement and that stickiness on the platform. And it's not just with the NFL. I think sports at large has been a big focus point. We heard David Zaslav, the CEO of Warner Brothers Discovery. He's consistently teased a live sports element on the Max platform. Bloomberg is reporting that will be free to Max subscribers in the next few months. And then come February, March, on the heels of March Madness, you're going to have to pay up for that. But live sports, live news, that creates a stickiness that I think all of these streaming giants really want, especially as competition escalates. And on top of that, you have the Hollywood writer's strike. So you're not having any scripted content. So live sports, that could be considered some of the best reality TV you could find.
But Josh, they're being judicious about the costs here too.
Yeah, no, they are. And I think that's something that sort of comes to mind here when you think about who was initially in play for this NFL Sunday ticket deal. And it's not fully out there exactly what happened, but there was a long period of time where people thought Apple was going to have NFL Sunday ticket that Alphabet now has with YouTube TV. And it seemed like from some reporting that was out there in the discussions, part of what happened was Apple didn't necessarily want the deal that the NFL provides because the NFL doesn't provide all access, right? The NFL is very protective over their media rights, and Apple is normally not like that. Apple likes to control everything, and they like to control the content. And so you see a little bit of a difference there between how Apple, which is used to dominating its tech space and dominating its space, versus how the NFL operates, I found interesting. And also just $2 billion is a massive deal, even if you are Alphabet or Apple. Yes, they make a lot of money, but that is a big investment.
Yeah.
And I think you're going to see some of these tech companies think, okay, I want to get in. I want to see what it's like. I want to do it. But do I want to spend $2 billion? I don't know. I mean, we're only a year into the Amazon deal, right? So it's probably too early to tell how that $1 billion for one game a week is really working out.
Is the NFL so protective over media rights because of all of the different types of productions that they envision being able to monetize? You think about the different documentaries that have come out. Quarterbacks was very successful for Netflix. And so now they're looking across the broader spectrum of what could be produced and how they could specifically line up different distributors for that.
To me, the one thing the NFL has been great at amid this media rush we have seen is they stay across different platforms. So you don't get pigeonholed into one platform and then get dictated by how that platform wants to make content, and also only be on one platform so you can only be seen by their subscribers. What if the service isn't that great, right? Or they end up having problems. The NFL has gone wide, and the NFL has really shown no interest in not going wide, right? They're on ESPN, they're on CBS, they're on Fox, they're on NBC, they're now on Amazon. That's clearly intentional by Roger Goodell and the NFL to be on multiple networks and not merge with, say, ESPN, like some of the leagues have reportedly been interested in talking with ESPN and Bob Iger and Disney, right? That doesn't seem like it's been the NFL strategy. They sort of want to go wide, Allie, and expose themselves to more streamers.
Right, which can get confusing if you're a consumer, especially as someone like me who loves the NFL, but sometimes it can get tricky to know which network, which streaming service now is airing what. But, you know, when we were talking about how expensive these rights are, I also think a big sticking point that's convincing a lot of these tech giants to get on board and spend those high amounts is the fact that they can advertise and monetize in that way. Because at the end of the day, the NFL commands a lot of viewers. If you take a look at the Nielsen top 100 most watched TV broadcasts of last year, 88 were NFL games, 23 of the top 25. So this is a behemoth that really attracts so many people, and that's very appealing to advertisers, and therefore it can command a lot of money.
And the other thing with that too that's been interesting that I think a lot of the street analysts point to is getting people in the ecosystem. Like the Amazon play for a lot of people, they'll say, has never been about getting more people on Prime Video necessarily. It's about getting people to use Amazon Prime, right? They want you to go on to be an Amazon Prime subscriber,
and
then shop for something.
Gear.
How are they going to How are they going to
jerseys.
push Amazon Prime ads on those broadcasts? That's the Amazon play.
Well, they haven't got me yet. Allie and Josh, thanks so much for joining us to help us break this down. Go Birds, yes, 100%
I'll go Pats.
there. What? All right.
Get it out there.
Fine. Actually, we play
Everything
you guys.
except football.
Ravens. Baltimore fan. Ravens out here. You bleed purple.
Remember the last time I watched I watched the Super Bowl last year.
There you go.
Eagles were in that.
Eagles were in that.
Honorary fan.
I didn't even remember that.
Well, Eagles-Patriots, guess we got a great matchup coming up to kick off the season here. All right, guys, thanks so much for joining us to break this down. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Halley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's next.
Almost an hour into the trading session. Let's do a check of the market sponsored by Tasty Trade. Once again today, we see this interesting divergence happening between the Dow, which is only down about 60 points, not even a fifth of 1%, and the Nasdaq, which is down about 1.25%. The S&P 500 hovering in the middle. The Nasdaq being pulled down in part by Apple, though Apple's also a Dow component, and this concern over China and the spillover into affecting U.S. companies like the iPhone maker. So that's something we continue to watch. And then also elevated rates and the effect that that has on sentiment around technology. Well, now that the ChatGPT-inspired market fervor has faded somewhat, investors are looking for more details on how companies are monetizing AI. And cybersecurity firm CrowdStrike has been doubling down on integrating generative AI into its security programs as it aims to detect breaches and counteract vulnerabilities. Enter Charlotte, CrowdStrike's program to speed and consolidate its cybersecurity offerings. CrowdStrike CEO George Kurtz is joining us now to discuss. Don't just want to keep it to Charlotte, but let's start with Charlotte, George. It's good to see you, by the way. Thanks for being with us. Talk to us about the reception for it thus far, and sort of how widely and broadly you expect Charlotte to be adopted by your clients.
Sure. We're really excited about Charlotte for a couple of reasons, and our customers are excited more importantly. So when we think about generative AI, as you said, some of the excitement has faded a bit because I think a lot of people, when they started using something like ChatGPT, they got excited, but it was a conversation and then it faded. And really, when we think about security and the use cases, we thought, well, how do we change the whole model? As opposed to having just a chat bot, how do we have Charlotte actually do work for a customer of ours? And one of the areas that we really focused on was SOC automation. That is the security analyst that has to come in and put an 8-hour shift in and triage alerts and figure out where the threats are, how it applies into their environment. That's like 8 hours of a lot of grunt work. How can we take that 8 hours and compress it into 10 minutes with Charlotte, where the analysts can have a conversation with Charlotte, ask about the latest threats, how it applies to them, and then have them actually Charlotte take action on their behalf, given the automation of the Falcon platform. So we think it's going to revolutionize security, and we're really excited to talk more about it at Falcon, our user conference in September in Las Vegas.
George, I think one of the considerations that many CEOs or executives who are implementing or deploying some type of generative AI or just largely artificial intelligence module into suites is how do they make sure that it doesn't cannibalize other parts of their business? How do you think about that at CrowdStrike and where Charlotte gets layered into or layered onto other services, but perhaps doesn't take away from the revenues that CrowdStrike has come to expect from some of those other services that are offered to customers and currently paid into?
It's a great question, and I think there's a lot of companies that are thinking about how they monetize and struggling. We have a plan to monetize it. We're going to announce that at Falcon, but we think it's going to add a lot of value to a customer. If we think about how expensive it is for a SOC analyst to be hired, how hard it is to keep them, how hard it is to find them, if we can provide value as a foundational service across all the modules that we have, we think we can actually, again, create an ROI for a customer where we can actually monetize and have them pay for it. So our goal is to be able to enhance our revenue opportunity as opposed to just have it as a cost.
Here's a weird question, George. Does the SOC analyst being able to have access to this, is the job more boring because of this, if you have AI doing a lot of these functions?
Well, I think in security, sometimes you like boring, right? You want to be able to understand what's happening very quickly, determine if you have threats or risk and what to do about it. And really what we're saying is the SOC analyst doesn't go away. But if you think about 3 levels, level 1 is sort of doing a lot of the grunt work and putting this information together and triaging. Level 2 and level 3 is kind of higher order operations of what does it really mean? What's the strategy? How do we enable the business from a security perspective? And that's where humans should be spending their time. So if we can drive automation and take a lot of the heavy lifting off their plate, we can free them up for doing things that humans are really good at. And that's really where we think they should be spending their time. And I think they're going to appreciate the productivity gains.
It's hard to imagine that you wouldn't need fewer people as a result of this, George.
Well, I think what it does is it enables the SOC to be more productive. So Does it mean they're going to be hiring a whole bunch more people? Maybe not, right? There's a productivity gain, but the people they have are going to be more productive and focused on the right things. And I think that's what's important. Just simple things like creating these shell scripts that do things on an endpoint or gather information, that takes time and effort. You can do that seamlessly with generative AI. So there's a lot of things that take time and effort. And if we can put the power of Charlotte AI in every analyst's hands, we think that's additive for our customers. And we think, again, it's a revenue stream that we can monetize.
And when you think about that monetization and the deal making that CrowdStrike is being able to do right now, I mean, we heard in Q2 over 80% more deals involving 8 or more modules than a year ago were able to be closed here. When you think about the environment for deal making, what is the level of scrutiny compared to or relative to quarters past, where we had continued to hear companies being more judicious about how much capital that they might be deploying towards spends for some of the different applications or software that they're using for their corporations? Where is it in comparison at this point?
Sure. If you look over the last year, really started to see the effect in Q3 last year of the macro headwinds. And I don't think it's gotten any better or any worse, but there's still a tremendous amount of scrutiny for each deal. More signatures, more scrutiny, more just time to get deals done. I think we've tried to manage that from a sales execution perspective. We put a lot of scrutiny on each deal, and we want to make sure that we can land them within the quarter. And a big part of what we've been able to do is to consolidate across the industry. So we're getting bigger deals, great, but it does take longer to get these deals. But the benefit is 8 modules. When you have 8 modules that you can basically land with, you're talking about a true platform and true ROI for our customers. And I think that's in part the success that you're seeing in the numbers.
George, always a pleasure to get some of your time, your insights here. Yeah, you feel more secure just talking with a cybersecurity CEO. George Kurtz, CrowdStrike CEO. Thanks so much for taking the time.
Great to be here. Thank you.
Definitely. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Seoul has more Starbucks stores than any city in the world, but Dan Halley isn't looking for a brown sugar shaken espresso. Find out why he's there on Yahoo Finance's next.
Welcome back. The tax preparation business has withstood many tests in the last few years, changing tax filing deadlines due to the pandemic, new filers thanks to stimulus benefits, navigating changes to America's tax code. However, tax preparation firm H&R Block has an optimistic outlook on upcoming seasons. CEO Jeff Jones believes the very unusual tax season we saw this year could soon return to normal. And he's here with us now in the studio. Good to see you. Thanks for coming in.
Good to see you guys as well. Thank you.
So normalization has been sort of the name of the game in many different industries. What is going to bring us back to a normalized, whatever normal even means at this point when it comes to the tax business?
Yeah, well, let me just step back. How did we get here? Because your opening said it. It has been crazy with all the impacts to the consumer and impacts to our company, no doubt. But over the last 5 years, our business has performed incredibly well. Our revenue's up 12%, our earnings are up 15%, EPS is up 66%, we've grown our dividend by 30%. So we've made a lot of progress and we have great momentum. And what is normal? You know, who knows? I think the tax filing code every year changes dramatically. But as we sit here today, we don't see anything on the horizon in legislation or otherwise that would suggest there's some big change coming. We, have to deal with natural disasters and those things impact the tax code. We can't predict those, obviously, but we're excited about the business, the momentum we have, and we're definitely ready for a little more normal.
Has the processing portion, after people have filed their taxes, has that gotten any quicker? There's been a huge hiring push from the IRS, and people are looking for their refunds more quickly after they finally, dot all the I's, cross the T's, and make sure that they cross their fingers at the same time.
Yeah, I always say we live in an age of impatience, and there's no way it's fast enough for any consumer. I mean, there's so much happening at the IRS, and obviously I'm not going to speak for them, but we absolutely support the need they have for more modernization, more people, because at the end of the day, when you try to call to ask, where's my refund, and you probably don't get the IRS, you call H&R Block. And we can't answer that question for you once we hand it off, but the consumer, we see every single year, they need their money. This refund is a really important part of their life, and so wondering where it is, getting the most they deserve every year, that's really what we're in the business to do.
I know you guys just reported earnings a few weeks ago. The stock rose on that. I did see some commentary around your core assisted tax business, seeing a little bit of market share losses there.
That's right.
How do you get that back? What are you guys doing?
Yeah, well, we're really clear, first of all, on what happened. And there were really 3 reasons why we lost clients. The first were those filers that make under $5,000 in income. They were in the system, if you will, to get their stimulus payments. So we see that portion of the market back to pre-pandemic levels. The second big reason was the timing extension in California. You mentioned it in your opening. When a filing deadline switches in our fiscal year, that obviously impacts our business. But the real focus for us is how do we serve the low and moderate income consumer better so they understand the expertise we offer, that we're there year round, that we defend them against the IRS. And at the end of the day, we offer a great value. And that's what we're focused on to serve some of those customers we lost this year as we get ready for 24.
The customer themselves has changed quite a bit here, especially since pre-pandemic. You have a lot more people that are virtual employees that have changed, how they work as well. And there are benefits that even they look for because that's what the tax law affords them too.
That's right.
How has that shifted, the types of returns that we're seeing, the types of questions that people are asking H&R Block as well?
The biggest shift that we see, Brad, and it's not intuitive to people, is people seeking help more than ever before. I think there's always been this belief in the industry that the old-fashioned way of someone helping you is dying. Everyone's moving to do-it-yourself software. And we just don't see that to be the case. Even people that start in DIY software are increasingly adding human help. So the questions they're asking are incredibly personal, but at the end of the day, they don't have the confidence to answer those questions for themselves. And so that's why they turn to help. And then, of course, the hot topic is how we're embedding AI in the product to make that help better for them, how we're innovating with products like MyBlock so they can get it virtually without going to an office. But at the end of the day, the American consumer is seeking help really more than we've ever seen.
Jeff, there's been some tension over the past few years between not just you, but the other tax preparation companies and the government over the free e-filing offering related to the IRS. And I've seen estimates of between 2 to 3% of all taxpayers are taking advantage of that, which seems off the top of my head low. But do you think that that is the ceiling because of what you're describing, that people do want more help and they're willing to pay for it? Or do you think there could be more room for people to participate in the free programs?
Well, so I think that the data that you're referencing is the people that take advantage of the government's free file program, not that take advantage of free in the industry. So there are over 30 organizations, nonprofit and for-profit, that offer free tax preparation today. We serve millions of clients completely free. And so the notion that the government wants to offer a free product really is solving a problem that doesn't exist, because you can get free really anywhere you want to turn. We do see people that start free want help. And that really comes back again to confidence. These questions are complicated. People lack the understanding of it. And so that's what we're here to do, is to deliver that expertise and provide help, whether you want to come to an office or start doing it yourself, or any of those virtual combinations that we offer.
Jeff Jones, H&R Block CEO, joining us here on set. Thank you so much for joining us.
Great to see you. Thank you.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Coming up, there's Yahoo Finance's tech editor, slack-jawed and spinning like a pinwheel. Does Dan Halley make it home, though? That's the big question. And does he even make it out of the town square? Find out. Yahoo Finance is next. Sprinklr beat Wall Street expectations in its second quarter results on Wednesday night, seeing 90 cents in adjusted earnings per share on $178.46 million in revenue. The company's growth driven by a 23% year-over-year jump in subscription revenue as the customer experience manager, CXM, now has 120 customers with deals over $1 million. Now they look to grow in the artificial intelligence space with an expanded partnership with Google. Joining us now is Sprinklr CEO and founder Raji Thomas. Raji, great to see you of these results from the most recent quarter, plus the partnership with Google. First and foremost, let's talk about the quarter. Any catalysts specifically that kind of stand out to you? Subscription was one of those areas that was mentioned on the call.
Well, Brad, good to be back and good to see you again. We had a lovely quarter by any metric, beat across the board, especially proud of the 12% non-GAAP operating margin that we posted. And that's for a company of our scale and growth. That's something that we were looking forward to.
Right, and Raji, where do you see the sort of biggest opportunity going forward here, especially in an environment where we have seen, some discretion, if you will, on the part of business spending?
But Julie, first let me just, for the benefit of the viewers, set the context. We provide a platform for large global companies to do everything from customer service to advertising and reach, engage, and listen to customers across any channel. We are in the front office software category, and that's a category that's going through massive transformation. And every company is focused on digital transformation. Every company is focused on customer experience and improving it, and we're an essential part of it. We've got three trends that are helping us on a macro basis. The first one is that all companies that we know of are looking to unify their tech infrastructure. Most companies have tons of point solutions, and it's so much better when they don't have to do 10, 15, 20 RFPs. And we're quickly emerging as the third or fourth large platform in the front office. That's number one. Number two, our focus and our approach to customer service, and we are a disruptor in the CCaaS space. And as we all know, it's a huge space. Only less than 20% of the contacts and the seats have moved to the cloud. And we're approaching that entire stack with a completely fresh perspective and completely built on AI. And that brings me to the third point, which is, the exciting thing that all of us are talking about is AI and generative AI. And we were one of the first companies in our space to bet the company on AI. And we started 5 years ago. And that's playing out really well for us.
Companies don't invest in AI solutions or making sure that it's a part of the offerings that they're bringing to their customers, like you are at Sprinklr, unless there is some type of monetization, unless there's some type of trickle through to the margins as well. What type of margin multiple are you expecting that artificial intelligence can provide to Sprinklr?
Brad, well, let me explain why we don't think about AI that way. We see that everyone's talking about AI today, and we see a difference between companies that embrace AI as a foundational platform strategy and embed AI into everything they do. And then we see a lot of companies take the approach of, well, we're going to have an AI product or have an AI feature or play into AI and monetize AI. We believe that the right strategy for us is the former. We deal with conversational data, unstructured data in over 100 languages. We're keeping a copy of all legally available external data for every company. AI is the only way for us to make sense of it. And we apply AI to everything we do. And we're betting on AI being a differentiating strategy for us in the long run, not a short-term monetization approach.
Certainly. Raji, just lastly, while we have you here as well, you mentioned the advertising component that so many of your customers rely on Sprinklr for and running campaigns, tracking the effectiveness of those campaigns and across social media entities. One of those social media entities has changed pretty profoundly and under new ownership in Twitter, or now formerly Twitter as X. Have you seen any kind of massive shift in how customers are running campaigns on Twitter, or even, engaging or running many of their campaigns on X?
Brad, we can't comment on any of our partners specifically, but what I can tell you is customers use Sprinklr as a way to normalize their advertising and marketing across channels. And so we see the media mix shift between channels, but regardless of where it goes, it's a good thing for us because we help them make their dollars work harder.
Yeah, no, it's a great connection point, and we both know this, having spoken over the years, formerly for me as a customer, and having seen the company evolve all the way through its IPO and continuing to cover you guys. Raji, always a pleasure to speak with you and get some of the insights from the top level over at Sprinklr CEO and founder, Raji Thomas.
Thank you, Brad.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Coming up, Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's next. The summer of 2023 will be Texas's second hottest ever. The average temperature of 85.3 degrees between June and August was second only to the summer of 2011. Thanks to the intense heat, the state's power grid struggling to keep up. Just yesterday evening, the power grid operator triggered emergency operations, which allows it to call on all available power generation to get ahead of demand. Texas has broken its power demand record 10 times this summer here, and as we're continuing to hear about even more of the calls once again to consumers to make sure that they are conserving energy to prevent blackouts. This is coming from both elected officials and some of the most prominent politicians within the state. Beto O'Rourke also saying, please conserve energy to prevent blackouts, hold off on using major appliances, raising your thermostat a few degrees, may be uncomfortable, but you can save lives.
Well, and obviously this is a problem not just in Texas, but across the U.S. The East Coast is now having a heat wave as well. And so this really draws into question grid security and resiliency across the country. And this topic comes up now and again. It's happened for ERCOT, the Texas utility operator, before that this has been an issue. And obviously, it's not one that has been fixed. So, you know, I feel like we're going to keep talking about this, and it's only getting hotter.
It is. And even amid the calls for continued kind of changes in operating procedures or considerations in the face of climate change, it's changed how customers or companies are also thinking about this too. We've put the question to many large cap publicly traded companies. Chipotle, we put this question to their CFO, Jack Hartung, just thinking about how they're changing even their sourcing as the earth is getting hotter. And so with all of that considered, how they're changing their operations, how they're changing their sourcing, the amount of energy and energy considerations, he had mentioned that in our conversation with him, saying that from an ingredient standpoint, they're considering it, but also from how they are keeping some of their own operations cool enough.
Right.
And this is raising some of the energy costs for companies and just trying to keep some of their facilities cold enough, given some of the fresh ingredients that they have to maintain as well.
Right, yes, and I imagine that's going to be an issue for things like tech companies and server farms as well, which already have enormous energy costs trying to keep those things cooled down. Yeah. So we'll see how that all plays out. Let's do one final quick check of the markets here. We do have a mixed picture with the Dow continuing to be little change, slightly to the upside. The Nasdaq falling, being dragged down by Apple and some of the other large cap tech companies that have been seeing a sell-off as of late. That does for us. Michelle Akufo's got you for the next hour of trading. Stick around.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. It's been a difficult earnings season for pet retailers. So how are they tackling a cautious consumer? We'll speak with the CEO of Chewy coming up this hour. And as corporations double down on generative AI, Intuit is throwing its hat in the ring as well. We'll speak with the CEO on the company's new AI-powered digital assistant. Plus, Barbie gave renewed buzz to the box office, but the ongoing Hollywood strike is throwing a wrench in theatrical plans. We'll share our interview with the CEO of IMAX on how they're combating this roadblock. But first, let's take a look at how the major indices are faring this morning. Seeing a mixed picture at the moment. The Dow, the only one in positive territory, but only just. It's been a pretty volatile morning here. We're seeing the Dow there up about 25 points, still relatively flat. The S&P 500 there also down about 0.5% there. Utilities leading the way. Tech under pressure, so that's down about 0.5%. And speaking of tech, the tech-heavy Nasdaq there off about 153 points, or just over 1%, as we hear on the reports on Apple not being able to be used by some Chinese government officials. They're potentially banning employees from using iPhones, so seeing some pressure there. Let's also check in on the Treasury market as well. Seeing those shorter-term yields there down by about 0.7%. Also the 10-year down about 1/3% as well, and the longest-term 30-year yields, that's the only one in positive territory, but ever so slightly. Well, we got some economic data yesterday that might appear conflicting at first blush. Two reports showing that US services industries are still in expansion, but each has different takeaways for investors. The ISM Services Index handily beat expectations with a reading of 54.5, while the S&P Global Services PMI narrowly missed expectations with a print of 50.5. So, which data point tells the real story of the US economy? Yahoo Finance reporter Jared Blickery is here with an answer. Jared, help us out here.
Well, thank you, Rochelle. First things first, stocks got a minor pop of that PMI print at 9:45 a.m. yesterday, but that was quickly reversed when the ISM Services print that dropped 15 minutes later at 10 a.m. So stocks dipped as a surprisingly positive ISM print means investors can once again, they're worried about higher rates, continuing the trend of good news for the economy being bad news for stocks. Meanwhile, the S&P data seemed to mostly slip under investors' radar. The ISM index saw business activity, employment, and new orders expanding as prices continue to rise. The only area that showed the slowdown was supplier deliveries. In comparison, the S&P's U.S. Services PMI saw business activity increasing at the slowest pace in 7 months, driven by a renewed contraction in new business. The index saw cost burdens taking a toll and weakening employment growth. PMI data supports more of the softening demand. So the differences in the two reports have to do with where they get their data. S&P Global only includes data provided by companies operating in the U.S. services economy, while ISM includes any activity other than manufacturing. So perhaps investors put more stock in the ISM's report because of its broader scope. And what we're looking at here is the S&P 500 sectors over the last 5 days. What's clear is that only energy is in the green, and also what stands out is that industrials, those are at the bottom of the barrel here over the last 5 days, the trailing week, down 2.6%. And it's industrials that are really reflecting what's going on in the economy and also the market. So you said something, or we said something earlier, good news is bad news, and I think that's continuing the trend here. I can show you some of the other sectors here. Let me take a look at the industrials over the last 5 days. You can see Boeing down 4.7%, Lockheed Martin down 6%, and we can look at the transportation stocks. Those are doing even worse. UPS down 6.4%, Southwest Airlines down 6.7%. So overall, good news, bad news for the economy. Good news, for the economy, bad news for stocks. I think that can continue, and it's kind of a vicious cycle. We've been talking about the stronger U.S. dollar, and all of this talk of higher for longer only builds confidence that the Fed is going to keep those rates high. That forces more money into the U.S. dollar, and then we see this weakness because U.S. dollar is actually a headwind for a lot of multinational stocks. So just kind of a vicious circle there, Rochelle.
Indeed, obviously making the Fed's job a little bit easier to keep pushing ahead, but having investors scratching their heads at the moment. Appreciate that breakdown. Our very own Jared Blickery there for us. Now let's move things over to Yahoo Finance's 3 to 5 anchor, Shauna Smith. Hey, Shauna.
Hey there, Rochelle. Well, let's talk about the pet business because we know Americans are cutting back on spending, even thinking twice before buying for their pets. But despite this tough economic backdrop right now, sales at online pet company Chewy, they were up 14% during the second quarter from a year ago. And the brand is gaining market share. Joining us now with a closer look at those results and also the consumer spending trends, we want to bring in Sumit Singh, Chewy's CEO. CEO, Sumit. It's great to have you here in studio. Thanks so much for joining us.
It's great to be here. Thank you for having me.
So let's talk about the trends that you're seeing in the consumer, because right now we've seen so many consumer-facing brands really seeing a pullback here on spending. Is that the case for Chewy? Because 14% jump in sales doesn't look like you're having that tough of a time.
Well, very proud for the 14%. And if you look at our subscription revenue, it actually grew faster than the overall 14%. So it's great. So what that tells you is that consumers continue to find value and convenience in the combination of those two really compelling right now. And we are offering both. But yes, you cannot ignore the macro. And so from that standpoint, consumers are appropriately, discerning between consumables and health categories relative to some hard goods and supplies category. And Sean, the great deal about Chewy is that 85% of our revenue in Q2 was driven by these more resilient consumables and health categories. So from that standpoint, we believe we are out there serving consumers well.
Are you investing more in those spaces as a result of the current economic environment?
Health has been a strategic investment for us for the last several years. And in consumables, we've built this credible business on the back of incredible proposition on pricing and great value convenience or delivery convenience. And so both, I think the complementarities are really powerful from a consumer point of view.
And we talk about how much people are spending. A couple of the numbers that jumped out to me in this report was that sales per customer from $330 per pre-IPO to $530 this past quarter. That's a jump of about 60%. When you talk about the loyal customer, what are the plans there in order to really continue on that growth trajectory and continue to get people to spend more at Chewy?
Yeah, I appreciate it. I really appreciate you bringing that metric up. So this metric, net sales per active customer, or traditionally in retail, you would call it share of wallet. Mm-hmm. And we really have been successful in consolidating share of wallet. And that's a core proposition of how we go to market with consumers. We have this predictability in our cohort behavior where consumers spend $100, $150 in the first year, but then, by year 5, 6, 7, they're spending north of $500, $600. Our oldest cohorts that are with us through 2011 through 14 are spending north of $1,000 with us right now. And so our goal and our plan has always been the same: help customers discover with ease, help customers bundle with ease, help customers subscribe to our product like AutoShip with ease, and that gives you reliability and predictability. Look, we're all busy. And so if we can take the pain of time management away from you and give you the way to supercharge pet parenting by being with you through the highs and lows of pet parenting, that drives loyalty towards the brand.
Yeah, and certainly consumers are always looking for convenience. Sumit, when you talk about pricing right now, are you still seeing higher prices from your suppliers?
Yes, so we're not seeing higher prices from suppliers. However, there is higher inflation still in the system relative to where CPG is trending currently, or where pet normalizes currently. So let me give you an example. Pre-pandemic, pet inflation used to be somewhere in the low to mid single digits. And currently, pet inflation is in the low double-digit range. And so it has started to normalize. It used to be even higher 3 months ago. But we believe it's going to take a few more quarters for it to completely normalize.
So what are you doing in terms of that pricing? Are you passing any of that along to the consumer?
Yeah, so the pet industry is for the most part MAP compliant. And what that tells you is that these costs that actually came through have essentially converted into price. And suppliers and companies like us are good at holding brand value up. And so in the market, and so consumers find even more value with programs like AutoShip, because when you subscribe, you get, the more you buy, the more you save. And plus, who wants to lug 40-pound dog food bags, back from kind of stores to their houses? So the online proposition continues to resonate pretty robustly.
Only people that are trying to get a workout in are
That's
those
right.
people that
That's
want
right.
to
It's
lug a 40-pound bag. Sumit, you guys are also expanding internationally. This international push, you're going to be opening, or you're going to be available here in Canada. Is that still on track, those plans?
That is absolutely on track. We are excited to be on track for the next, in this quarter, actually. We're in Q3 now, and we are going to launch Canada. We're starting with Toronto. Tremendously excited about bringing the Chewy value proposition to Canadians.
And how significantly do you see that growing your business?
Well, so Canada is a fast-growing market, and e-com penetration in Canada is behind the United States. So you would look at Canada e-commerce and say, US was here roughly 10 years ago. But it's accelerating at a much faster rate. If you normalize for the pandemic, the normal organic growth rate in Canada is faster than it was in the United States. And so, the same way that we approach our customers here in the US, pricing, convenience, personalized service, all of these are tenets or propositions that consumers and Canadians will hopefully migrate towards.
And speaking about investments here, opportunity within the space, I also know that you've been increasing your investments into automated fulfillment centers. What has that done in terms of headcount and and why is that the right move for Chewy at this time?
Yeah, so first of all, we invested because we believe in creating a great team member experience. And so the safety and ergonomics that automation can bring to your team members is just incredible. Beyond that, there are financial gains to be had because automation allows, think about a picker walking in the warehouse. They're walking, right? Or they're pushing carts to pick and pack per se. If you can automate those states and bring goods to the workers, you can essentially drive greater throughput from the building, and that converts into lower cost structures for us, which is exactly what we're doing. So our supply chain transformation is allowing us to place inventory closer to customers, and our automated footprints are allowing us to fulfill that volume much more efficiently. So we see it as a strategic investment that we are well down the path to.
Smith, I got to ask you about the stock price right now because the stock has been under pressure along with many other consumer-facing brands over the last several months. It's off just about 37%, I believe, year to date. What's the street missing?
Yeah, so, look, the stock does what it does in the short term. Ultimately, we believe long-term orientation. If you look at the trends moving, pet continuing to move towards e-commerce, Chewy as a player continuing to earn trust with consumers, and the combination of that really drives the long-term algorithm is sound and structural. And so I think near term, everybody is feeling the pressure. And so to the extent, if you want to go back to the old adage, in the near term, the stock's a voting market. In the long term, it's a weighing market. We'd rather be weighed upon than be voted upon.
There we go. All right, Sumit Singh, always great to have you, CEO of Chewy. Thanks so much for joining us in studio today.
Thank you, Shauna.
Rochelle?
All right, great stuff there, Shauna. Thanks so much. Well, as AI remains the buzzword of earnings season, the risks associated with generative AI are unprecedented and growing. And with the upcoming 2024 presidential election, you can most certainly bank on the appearance of AI-generated campaigns. Google announcing earlier today that it's updating its political content policy. The new mandate will require election advertisers to disclose when their advertisements have been created or informed by artificial intelligence. Now, the new policy update will take place in mid-November. Well, staying with politics, President Joe Biden's son is in hot water again. Federal prosecutors indicated that they plan on indicting Hunter Biden by the end of the month. To tell us more about this, Yahoo Finance reporter Rick Newman. Hey, Rick.
So this case has been going on for something like 5 years, and there was a plea deal that fell apart over the summer, which means that Hunter Biden is now going to be prosecuted. Presumably this will go to trial on one charge that involves felony possession of a gun. He lied about being addicted to illegal drugs when he filled out a form after purchasing a weapon. So that would be the crime. And it's possible he's going to also get charged for 2 tax-related offenses, basically tax evasion on around $3 million in income he earned in 2017 and 2018. He didn't pay taxes on that at the time. He has since. But I mean, you could argue this is all a good thing because the Hunter Biden saga has been simmering behind the scenes. And the real question is not what did Hunter Biden do? I mean, he and his family have admitted he has had a troubled life, been addicted to drugs for periods of time, and made some bad decisions. The real question is, did President Biden have any involvement in anything that might have been criminal that involves Hunter Biden? And more broadly, did Joe Biden, when he was a senator, the vice president, or even the president, did he benefit financially or in any other way from Hunter Biden, who was clearly cashing in on the family name by being involved with businesses in Ukraine and China and elsewhere? So very important to note here, as far as we know at the moment, there is no evidence that President Biden did anything, certainly that he did anything criminal, and really no evidence that he did anything wrong. He did communicate with his son Hunter while Hunter was involved in some of these business dealings, and Republicans are trying to make the connection that, oh, he made this phone call at this such and such a time, and some business associate of Hunter happened to be in the room. But they've got nothing on Joe Biden yet. So let's bring this to trial. Let's put all the evidence out in the open for Americans to see, which is better than a plea deal, which is kind of a private arrangement. So let's let everybody see what's going on here. So if there's anything linking Joe Biden to any criminal activity, let's get it out, even if it's in the middle of the 2024 election. And if there's no evidence, then let's put it all out there and then get beyond it.
And we know that there's no lack of current and former presidents, in the midst of some of this political and legal turmoil, especially as we consider Trump as well. I want to shift gears to international relations now, because a report is out today saying that Beijing officials are banning the use of iPhones by government employees at work. So what does that mean for the future of US and China trade relations?
Possibly nothing. Now, Apple stock is down sharply by more than 3% today on this news. But to put this in perspective, this is the Chinese government saying, we don't want government officials using iPhones. Government officials are a tiny portion of Apple's customer base in China. And if it just ends there, then it's kind of a nothing burger. This is a big deal because Apple gets almost 20% of its revenue from China. It might even be a bigger market for Apple than the United States. And the reason the Chinese government is doing this, I don't think this is for hostile purposes. I think they're doing this because there's a long-going effort to emphasize homegrown technology. So think Huawei phones rather than Apple phones. And there is this very interesting new Huawei phone that just came out with an advanced semiconductor. So this could be the Chinese government's effort to just favor the home team a little bit, boost the home team. If Apple is able to continue to sell its iPhones to any other Chinese citizens who want one, then there's probably no problem. I guess the real question is whether there could be some broader crackdown on Apple phones, which would probably create a bunch of problems, including possible retaliation that China doesn't want to get involved with. So best bet is that this is going to be limited to just Chinese government officials, and that really won't hurt Apple very much. I looked at the Apple stock. It is down 10% since the end of July. So I'm not making a buy or sell recommendation here, but I wouldn't be surprised if there were some buy the dip recommendations on Apple stock at this point.
I mean, certainly you have to wonder, as you mentioned here, where it goes from here, and especially with the US and China involved in this high-tech chip battle as well. But I know you'll be keeping us posted. Our very own Rick Newman. Thanks so much.
See ya.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Seoul has more Starbucks stores than any city in the world, but Dan Halley isn't looking for a brown sugar shaken espresso. Find out why he's there on Yahoo Finance's next.
Our executive editor, Brian Sozzi, is getting deep insights into the state of the tech industry at Goldman Sachs Communacopia and Technology Conference. He joins us now live on the scene. Brian, I know you've been busy. It's day 3 of this conference. You've had some big interviews. What are some of your biggest takeaways so far?
Going strong here, Rochelle, that is to say the very least. Lots of talk about AI, of course. In fact, my brain is just on overload from all things AI. I actually had to write some of these takeaways down so I didn't forget. First up, really, there's a lot of, I would say, Microsoft creep at this event. Microsoft, of course, has that big deal or partnership with OpenAI, and there is concern in the room really across 3 days on how deep and how far that relationship is going to go over time. And what does it mean, Rochelle, to companies like a Zoom and other players in cloud security that are having to compete with an increased or beefed up Microsoft and AI? So that's one. Number two, there is, I would say, a little bit less appetite to own big cap tech stocks here. And I think you're seeing in the market action by you guys today or overall in the market with Apple, you're seeing Apple under pressure here. There are concerns about higher interest rates and how far they may end up going, concerns about how tech ultimately compete effectively against China over the next few years. Now, all the panels here have been well attended. There's been a packed house, standing room only in many respects, depending on what company you are. But again, that appetite to buy the dip on some of these tech stocks, not necessarily there just yet. Again, that's just my interpretation of it. And then lastly, this is not a great time to be a tech company in a turnaround. And I look at the action, Michelle, yesterday in Peloton. I mean, they had a disastrous earnings report about a week and a half ago. The stock got slammed yesterday as CFO Liz Connington presented here at the Goldman Sachs conference. And she said really everything you don't want to hear from a tech company right now, thinking or saying that things are going to be a challenge to turn around at Peloton, more investment in personalization. And you got the sense from that presentation that a company like Peloton is going to struggle to turn itself around in a land of higher interest rates and a more cautious consumer, Rochelle.
I mean, that's fascinating stuff, though, and I know we do appreciate you having us on. And I know you also have some other big interviews coming up today.
Well, I'm glad you mentioned that, Rochelle. In fact, I have one right now. While all the talk here at Goldman Sachs has been on AI and the future of media and the future of tech, another key player that we follow very closely at Yahoo Finance as it pertains to the economy, small businesses, and AI, that's Intuit. And joining me now is Intuit CEO Sasan Goodarzi. Sasan, always great to get some time with you. Miss you here at this Goldman Sachs conference, but I know you have a lot of big AI initiatives and AI news hitting the tape here from your company today. Take us through exactly what you are announcing. My interpretation of it was you're layering in new forms of AI across your various platforms, TurboTax, Credit Karma, MailChimp, you name it.
Well, Brian, first of all, great to see you. I missed you at Goldman Sachs, but I know our CFO was there. So listen, yesterday was an enormous day for Intuit. At our Intuit Innovation Day, we launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help. That was the big news yesterday. If I were to double click a few examples of what we launched, for small businesses, now you have the ability to be able to grow your business, and we work with you to develop a marketing campaign. For instance, if you just came out with a new product, let's just say it's some modern furniture, we work with you to help you create an entire campaign. What kind of images, what kind of content, who do you want to target? You are always in control of being able to adjust the campaign itself, but we develop it all for you. And then once you confirm the campaign, we execute it for you and then help you with what the results are, what your cash flow is from that campaign, and what the next steps are, almost like you're sitting across the table from your marketing team. And really the intent is, based on all the data that we have access to, all of the investments we've made over the years, the last decade in AI, we're able to tip the odds in the favor of those that need it most. So it was a really exciting day yesterday, and we can't wait to launch all of these capabilities over time to our customers.
Out of all the very large businesses that you operated into it, Sasan, which business will AI play the biggest role moving forward?
Brian, it's all of them, because if you just sort of step back and think about the problem spaces that we focus on, Consumers are trying to make ends meet. They're trying to get out of debt. They're trying to save money. They're trying to, make more of the money that they have. And small businesses, their biggest focus areas are how do I grow my customers? How do I retain them? How do I grow revenues? And how do I manage, my cash flow? So across our platform, Credit Karma, TurboTax, and across our small business platform, which is MailChimp and QuickBooks, this notion of delivering personalized, intelligent experiences is really important. So I'll just use another example for you, which is Credit Karma and TurboTax. Ultimately, we're trying to help you make ends meet. And so if you are in a situation where you have a big unexpected cost, your car breaks down and you have to have a large expense, we detect that on the platform. We will send you a notification that says we can see that you've had a big expense. You have a cash flow issue. Here are several ways in which we would suggest that you can address your cash flow issue. We can give you early access to your wages. You can take out a personal loan at the lowest rate that's already been pre-approved for you to ultimately get you back up and running. And that's, think about the power of having an assistant in your pocket that is by your side every step of the way as a consumer or a small business to help power your prosperity. So really all of our investments over the years in data and AI, it's why it's been core to our declaration 5+ years ago, has really been to create a future where it's done for you. You're always in control, but it's done for you. And it applies to every part of our platform across consumers and small businesses, which I think is what makes this era of data and AI, and particularly Gen AI, so exciting, because I think it will ignite global innovation and create new economies.
Sasan, we see in the market action right now, lots of continued fear about rising interest rates and what it means to consumers, households, not just today, but of course in 2024. Your company offers a real great snapshot into some of those trends via Credit Karma and some other businesses, but notably Credit Karma. How strained are small businesses and that Gen Z consumer right now?
Yeah, well, first of all, for your viewers, we have over 100 million customers across our platform, across all of our platforms. So there is a lot that we see. I'll start with small businesses. Small businesses across the platform, their cash reserves are about 90% of what they were this time last year. Now, although it's down, it's actually significantly better and more improved than it was prior to the pandemic. So although they are being impacted by the current environment, they are actually in better shape than they were several years ago. On the consumer side, we see a couple of things. One, since March of last year, credit scores are down 13 points. Generally, credit card balances are up over 30%. And particularly with Gen Z, since you asked about them, their credit card balances are up over 45%. But many consumers have jobs. And so although they are being impacted by the current environment, they have jobs, but they're being strained in terms of being very intentional about where they're spending the money. And those are some of the stats that I think demonstrates jobs at the same time strained by the current environment.
Mental note to everyone watching this, cash is still king. Use cash. Don't have to put in your credit card sometimes. We'll leave it there. Intuit CEO Sasan Goodarzi, good luck with the AI journey. We'll talk to you soon. We appreciate you coming on, like always.
Thanks for having me, Brian. Take care.
Thanks so much. All right, do tune in. Much more ahead on Yahoo Finance Live on this very busy day for all things markets and stocks.
Coming up, Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's Next.
Let's do a check of the market, sponsored by Tasty Trade. Looking at a mixed picture here still. The Dow, the only one seeing some green there in positive territory, up about 50 points on the day. The S&P 500, though, still under pressure, down 0.4%, at least off its session lows, though, down about 18 points. Tech-heavy Nasdaq seeing the biggest blows here, down about 160 points, or down just over 1% here. In terms of sectors, utilities leading the way, tech under pressure, and of course on those reports that Apple could have in China, the government having them not use their iPhone devices in the workplace. So that also weighing, especially Apple, dragging down the Nasdaq the most. Well, your chicken wings, hot dogs and breakfast sausage could soon transport themselves. Almost. Mega food producer Tyson is teaming up with autonomous vehicle maker GATIC to test driverless trucks in the Northwest Arkansas. Now, Yahoo Finance's Brooke DePalma is here with the details. Sounds like music to all us food lovers' ears right now.
Sounds like music to my ears, too. I mean, what an innovation. The future is here, Rochelle. Essentially, Tyson using AI technology to transport its inventory as the company continues to tackle the supply chain issue that it faced in the recent quarterly results. So really, what this comes down to is Tyson is teaming up with GATIC. It's a multi-year contract that kicked off last week. It'll start with 4 trucks that'll roll out and essentially work to deliver those products, inventory from the plants to cold storage facilities. Now, GATIC did create these Class 7 autonomous vehicles specifically for Tyson to create an opportunity to carry those heavier foods. Now, the next several trucks will be delivered in about a month, and that middle mile is what they're really looking to get at. These will be used in shorter trips, think 10 to 15 miles. And what is being tested right now is something that for the time being will actually have a person inside the autonomous vehicle as that AI technology learns these routes. And essentially, when we talked to Tyson, they were very optimistic about this rollout as the company looks really to double down on its supply chain. They said that there's about 40 sites that, should this all go well, that they've identified where this autonomous vehicle technology can be used to transport its inventory once again from those cold storage facilities, or rather from the plants to the cold storage facilities. And one executive telling Yahoo Finance that this really is a productivity gain. When you think about drivers, based upon rules and safety rules set by the DOT, they're only allowed to drive about 11 hours a day. But when you think about these autonomous vehicles, they could essentially run all day, but they intend to use them for about 18 hours a day. And other partners that GATIC has teamed up with also include Kroger, as well as Tyson's next door neighbor in Northwest Arkansas, Walmart. And so certainly lots underway in Tyson's HQ, but also it'll be interesting to watch the efficiency gains that comes from Tyson in the months to come.
Indeed, interesting development there, especially since, during the pandemic, we were talking about a truck driver shortage.
Absolutely.
So clearly some solutions here on the table. Brooke DePalma, thank you so much. Well, the data-dependent Fed is determined to get inflation to that 2% target, but with conflicting data, an increasingly weary consumer, and an economy picking up steam, our next guest is warning that the Fed will have to continue tightening until they break something that could have large impacts on the economy. Let's bring in Optimal Capital Director of Strategy, Frances Newton-Stacy, to get her insights. Good to have you on the show here. So talk about the position that the Fed is in right now and where we are in the inflation story.
Well, the thing is that the Fed was winning on inflation. I mean, they were tightening and tightening and tightening. We didn't have a credit event, and inflation looked like it was decelerating. The problem is that inflation is re-accelerating, and that's largely due to the 30% gain in oil of late. And all of these things, even 13% up in orange juice or 13% up in, rubber and things like that, all of these commodities prices that are going up have a lagging effect coming into headline CPI. Against that, you have easing base effects. And so that's going to reaccelerate headline CPI. And so from the headline basis, the Fed has to stay really, really hawkish. But why is the Fed funds future still pricing in rate cuts next year is because we do think that there is a threshold here and they will ultimately break something.
So then, Frances, to that point then, where would we start seeing some of these cracks in the economy start showing up that would signal that the Fed is over-tightening?
Amazing question. So that's the gazillion-dollar question. We have 60% of the American consumers living paycheck to paycheck. They're taking on increasing an increasingly onerous credit card debt with APRs, averaging above 20% at this point. And every time the Fed tightens, that gets worse. We have student loan payments coming back online. We have had an inflection in foreclosures, bankruptcies, and delinquencies. We're seeing that sort of a thing. So if any of that gathers momentum, we also have a lot of risk in the commercial real estate market, which is over $3 trillion, which is about 20% of the assets held on banking balance sheets are at risk. We have corporate bonds. Some of those are coming up for refinancing at these much higher rates. And, corporate debt it's just the entire economy is completely overlevered. So which one breaks, I'm not exactly sure. We are starting to see some cracks in the labor market, though.
And I do want to ask you about the consumer. I mean, we heard from the San Francisco Fed saying, look, all those pandemic savings that consumers had built up since the pandemic, those are supposed to be running out this month. But it doesn't seem like markets are pricing in just how much pressure the consumer is under when you do factor in things like repaying student loan debts. And, a lot of people stuck in houses that they can't sell because they don't want to take on a new mortgage as well. What do you think the market is missing here about the consumer?
Well, the market's still pricing in a soft landing because we're 20 months into the tightening cycle, and really we haven't seen any major credit event other than the banking thing, which the Fed was able to shore really quickly in March. And so the market has some complacency definitely priced into it. But the thing about it is you had a lot of you had anomalies galore in July. You had Barbie, you had Taylor Swift, you had Beyonce, you had savings going down, which were being spent by consumers. And you had, mortgage prices had gone under 7%, gas was lower. You kind of had those things hitting a trough simultaneously. And now all of those things are reaccelerating simultaneously with higher prices, more onerous credit situations, student loan payments. So a lot of the factors that created this amazing resurgence in July of the consumer are kind of fading into the background against, again, a Fed who may or may not may pause for September, but definitely they're thinking that they have another hike on the table this year.
We're certainly seeing some of that reality at least kicking in for markets this morning. We'll see if that momentum continues. A big thank you there to Frances Newton-Stacey, Optimal Capital Director of Strategy. Thank you for your time this morning. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
The debate over student loans comes to a head as federal payments are set to resume October 1st. Many of Americans, millions in fact, are about to possibly have their finances turned upside down. So, where do we go from here? Yahoo Finance is here to address some key questions surrounding the student loan crisis, like what loans qualify for forgiveness or even cancellation? What tools does the Biden administration have in its back pocket to address student loans? How will payments impact the economy? And how should you be rebalancing your budget for this new expense? And finally, are student loans worth it? Join us for our special Student Loans, Crisis or Crucial, right here, starting Monday, September 11th on Yahoo Finance.
Yahoo Finance is at the Goldman Sachs Tech and Media Conference. And of course, everybody's talking about artificial intelligence and what's next for media, but there are other things to talk about. In this case, let's talk about the business of movies. We have lots of focus on all things Barbie, what might come for that franchise after that big release. Lots of eyes, of course, on Oppenheimer and what may happen to that franchise moving forward. Let's talk some movies here and the future of that business with IMAX CEO Rich Gelfond. Rich, always great to get some time with you. We appreciate it.
Yeah, happy to be here.
I mentioned Barbie, I mentioned Oppenheimer, but I really have to start on what you're doing with Taylor Swift. Where are you at with Taylor? How many theaters have sold out, and what are ticket sales look like?
Well, IMAX has about 350 sellouts for the opening weekend. I think there's still capacity left, but the total pre-sales overall are over $65 million. I mean, it could be $100 million weekend, which is just mind-boggling. So I think the idea was the Swift family knew the concert was so successful, but they wanted to make it more accessible. So rather than going direct to streaming or a pay window, they wanted to make it like you were there, but make it really affordable for a lot of people. So they went to AMC and they negotiated to do all of AMC's theaters. And then AMC went out to other players who they thought would add value. And in the case of IMAX, we're going to kind of take the movie and enhance the sound and enhance the visual. So we're hoping it'll be just like you were there, and couldn't be more excited.
Can you take us inside that technology to the extent you could? How might watching Taylor Swift on the big screen look different because of that technology you possess?
Well, in IMAX, what we'll do is we have a 12-channel sound system. So that's not typically what a cinema has. So we have to upgrade the sound and do different things to it to make it really optimized for the IMAX system. And then on visual images, what IMAX does for any film not shot with IMAX cameras, we up-res the film. It's called DMR. So it goes through a process where we enhance the image. So when it's shown so large, instead of looking blurry, it looks super sharp. So I think it'll be really exciting to see Barbie up to 8 stories high with incredible sound.
Well, I know the Swifties back in the Yahoo Finance newsroom will be very excited to hear that, Rich. Let me ask you this too: Are we looking at the future of the movie theater experience changing, looking through the lens of what Taylor Swift is doing here? Whereas, I mean, we're not just going to a theater to see a movie. There's other things that can happen in the movie theater.
Well, I think you're looking through the future of the movie-going experience through the lens of IMAX. So while the traditional movie business has been down from its peak in 2019, we're tracking to that level now because people really want to see premium experiences. So you can marry your two parts of your question. The Taylor Swift concert in itself was a breakout, and I think that's because people wanted a premium concert experience. There was a premium price. It did over $1 billion. And in the case of the movie business, I think people are flocking to IMAX also because they want something different than sitting in front of their home screen and streaming. But even, re-releasing Barbie later in a different way is something new. We're doing a movie with A24 about the talking heads that comes out next Monday, and there's a live Q&A around it that's going out. So I do think you'll see different variations and different alternatives to the traditional movie-going experience.
I got to spend some time at the conference here, Rich, with Paramount CEO Bob Bakish, and I didn't get the sense that this Hollywood strike is ending anytime soon. Now, he seems, my interpretation was they have a good amount of content in the backlog, but what happens to summer 2024? As someone operating in the movie theater business, are you concerned that these players like a Paramount and Disney can't get the content they need to support the movie theaters?
So IMAX is much more agile than almost any company in the entertainment space. And in fact, we sort of see ourselves as a port in the storm. So about 25% of our content is local language content, unaffected by the strike. Some of it is alternative content, which the type we just talked about, unaffected by the strike. 65% of our content is outside of North America, largely unaffected by the strike. And we're very flexible. So we have, this month coming up, we have Killers of the Flower Moon from Apple. We have Napoleon from Apple and Sony. So streamers are actually generating content. So I think after pandemic, there are a lot more sources of content than there were. Now, with that said, IMAX, we're a very talent-friendly company. We really want this to settle in a way that talent feels good about it and creates as they would. And, I'm an eternal optimist, so I refuse to put a negative head on it.
You mentioned overseas. Now, I think investors maybe not familiar with the fact you have a big business in China. Now, a lot of headlines we've been getting lately, China slowdown. Have you seen that in your business?
No, I mean, China just came out of the pandemic in December of last year. And when everyone came out kind of a year before that, it took some time to get back to normal. So our China business is way better than it was during the pandemic, but it's on the road to normal. It's not there yet. And in terms of content, we play local content as well as content from outside of China. And right now we're playing a movie called Creation of the Gods. We've done $35 million in China. We released Oppenheimer in China. The opening weekend in IMAX, we did 30% of the box office, or about $9.5 million. And we had another movie this year in China called Wandering Earth 2, which we did over $50 million. So no, the mix might be a little different, away from Hollywood films to local content, but we play both. So for us, we haven't seen major obstacles.
We've seen a lot of just tensions between the U.S. and China. Now, your company made an early bet on China has been winning. I mean, do you ever just get worried about your business not being able to operate the way you would like to operate in China because of these tensions?
I mean, I get asked that question a lot, but Apple does okay in China. Starbucks does okay in China. Auto companies do okay in China. I've been to China over 50 times, so I have a familiarity with it. So I think once you've been there and you see the weekly results, you don't react the way that's kind of caught up in the political landscape. I'm not particularly worried about China.
All right, I'll leave it there. IMAX CEO Rich Gelfond, always a pleasure to get some time with you. Thanks for making time for Yahoo Finance.
Thank you. I appreciate it.
All right, much more ahead from the Goldman Sachs Tech and Media Conference all week long on Yahoo Finance. We'll be right back.
Coming up, Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's Next.
Anticipation for IPOs this month is brewing. The listing of semiconductor firm ARM Holdings next week and Instacart later in the month is giving some hope that the IPO market may unfreeze. But an IPO like ARM isn't just good for companies looking to go public, it may turn things around for Wall Street. Our Yahoo Finance reporter David Hollerith has more on this. David, what are you watching?
Rochelle, yeah, IPOs are only one part of the investment banking business. But for the country's biggest banks, including JP Morgan, Bank of America, Goldman Sachs, Morgan Stanley, it has a lot to do with their revenue and their performance throughout the quarters. And in investment banking in general, IPOs especially, have sort of been in this freeze since 2021, which had just unrealistic high volumes. So 2022 is sort of like the year anyone in investment banking would care to forget. And 2023 so far isn't looking necessarily to be much better. And that's put stakes for the IPOs this month to be pretty substantial in terms of what it could mean for the banks. I've spoken to a number of bankers at some of these firms, and they've made it clear that even accounting for expectations for where the estimates of ARM is and Instacart and other known IPOs, 2023 is still looking like for the U.S. investment banking market, or I guess we could say the U.S. IPO market even, it's still looking to be below historical standards. But these first sets of IPOs are going to be a big test case for how investors are feeling, and that can influence how the capital markets are, whether or not companies feel like they're comfortable with maybe doing a merger or an acquisition, or trying to do other capital formation. So the stakes are pretty high, and ARM is kind of an interesting one as it was previously public, so it's kind of a known quantity. And that makes it maybe not the best test for the market as a whole, but a very good starter. So the Wall Street analysts I've spoke to have sort of set expectations here that we could still see weakness in investment banking based on historical standards throughout 2023, and it might even carry over into 2024. But what we see, starting in September, starting next week with ARM, is really whether or not this market is sort of headed on the upswing, whether or not we might be at an inflection point here. So it's obviously really important for the big banks. And next week, we're going to hear from a bunch of those executives on Monday and Tuesday. So they'll be offering updates, and we'll probably have a lot more color there.
And you raised an interesting point about ARM being at least a previously known quantity, being that it had already been public before. Now, David, we also know that the FDIC released their second quarter banking sector report this morning. What were your takeaways from that?
Yeah, so we already did see, company-specific information through earnings that we covered. But what we saw in aggregate about the U.S. banking industry is that deposits still declined, and this is the fifth consecutive quarter, but they declined at a much slower rate. And really, the story for the second quarter for banks was all about the rising cost of funds, and the cost of funds rose more than loan yields banks give for making loans. And that's still a problem. It's still going to continue to be a problem with higher interest rates. And the FDIC's chair, Martin Gruenberg, actually took sort of a note of caution there, where he, warned about how these at risk and then also diminishing asset quality will also be in the forefront of their minds. So declining asset quality we've seen, and then obviously pressures on profitability. Those are the two main things that banks are sort of bearing down as we look for the rest of 2023.
All right, appreciate that update. Our very own David Hollerith, thanks so much. All right, well, that does it for now. I'm Rochelle Akufa. I'll be back with you tomorrow. We'll see you then.